Yesterday had a pretty dramatic pair of bars late in the day. On the daily chart, the market has been rallying strongly for several weeks, 4 weeks, very tight bull channel. However, you end up getting exhausted bulls, which simply means that the risk becomes too great. Traders look to where their stop is, either here or here, and they conclude that if the market goes down and hits their stop, they'll lose much more money than they want to lose, and they end up having to reduce their position size. Let's say you have a $1,000 account and you're willing to risk $200, and now the stop is more than $200 away. You have to reduce your position size to keep your risk at the maximum tolerable risk, $200. I'm using very small numbers just to illustrate the point. So if your maximum risk for your account size is, pick a number, $200, and your stop requires you to risk more than $200, you have to do something to put your risk back down to a tolerable, acceptable level. And the easiest way to do it is to take profits. And that's why climaxes typically result in pullbacks. And that's what people mean when they talk about exhaustion. They're talking about traders have profits that are so great that their stops are so far away that they have to reduce their position size to maintain their risk. That was true on the way down here. And I said it was likely we were going to get a significant reversal because the bears at this point, their stop is way up here, and that's much more risk than what they're comfortable maintaining. So they have to reduce their position size. And once the market starts to go up, the bears start to panic, and they quickly reduce their position size. They cover their shorts. And that's why any reversal from a sell-off begins with short covering, and any reversal after a strong rally begins with long liquidation, bulls liquidating, taking profits. So it begins with profit taking. A bear trend that becomes a bull trend begins with profit taking. A bull trend that becomes a bear trend begins with profit taking. Normally, you don't go from a bear trend to a bull trend. You go from a bear trend to a trading range. And therefore, I think this is probably a bull leg in a trading range that will test back down somewhere to the middle of it over the next month or so. And likewise, this is a bull trend, very tight bull channel. It's unlikely to go to a bear trend. So even if we sell off, which we probably will at some point in the next few weeks, it'll probably be a bear leg in what will become a trading range. Yesterday we had a pullback in a tight bull channel. So yesterday is a high one bull flag, but it has a bear body, and the channel has 3 pushes up, 1, 2, and 3. So it's a parabolic wedge. These 2 bars are strong enough so that we might get 1 more push up. So we might get 4 pushes up, 1, 2, 3, 4. However, the stop right now is not below this bar. Most traders who are long from anywhere in here have stops that are far below, like here or here, below a major higher low. This is a minor higher low. So we can go above this bar and then down a little bit more, above, down, and we can start stair-stepping down. Right now, this is a high 1 bull flag. If we go above and then to a new low and above and a new low, it could become a high 2 or a high 3 bull flag. The pullback could continue to grow. And if it grows to 10 or more bars, I start to call it an endless pullback. And that's what I think we might get, either starting here, or we'll go 1 more new high and then an endless pullback. Like here, this is a small endless pullback. Sometimes it can last 20 or more bars. Sometimes it can last a lot longer than that. Anyway, yesterday's a bad buy signal bar, so there probably are bears selling above yesterday's high if we get above yesterday's high. Bear channel, bull flag. 75% chance you're going to get a bull breakout, which we did yesterday. And right now we have a gap up. We're above the 60-minute moving average. Very tight bull channel, a little bit of a blow off top. So we might get a couple legs sideways to down. 1, pullback. 2. In fact, we probably will. Big up, big down. Big confusion usually results in a trading range. So we're trying to resume the bull trend. We're breaking above the bear channel, the bull flag. However, the sell-off was strong enough so that we'll probably get a lower high and the second leg sideways to down. And as I said, even if we go up here, there probably will be sellers above here. The bears who sold this high and sold more higher made money. That will encourage bears to sell at this high and sell more higher, confident that they'll make money. So we know there are sellers above this high. All right, so we finished yesterday always in long, and we have a gap up and a bull bar closing on its high. We have room to yesterday's high. So theoretically, it's a decent setup for a trend from the open bull trend. So can you buy right here? You can. We're very far above the average price. When the market is far above the average price, it usually struggles because traders typically do not like to pay too far above average. They don't like to buy far above the moving average. And typically when you get a gap up like this, a big gap like this, and you start to rally, the rally has a hard time going up more than 4 or 5 bars. 80% of the time when there's a big gap up or down, the market ends up in a trading range for the first hour or so. The bears will try to get a double top or a wedge top, and the bulls will try to get a wedge bull flag down to the moving average or a double bottom around the moving average. And the market usually ends up going sideways until it gets to the moving average. And then the traders decide, is it going to be a wedge bottom, a wedge bull flag, or a double bottom at the moving average, and then a bull trend day, or will we get a double top or a wedge top and early high of the day and a bear trend day? Here's the moving average, so a gap up. It rallied strongly for a few bars, but sold off near the moving average. The bulls got a double bottom, and we got a swing up. Here, big gap up. Here's the moving average, and we got a wedge bottom, high 1, high 2, high 3, and then a rally. So 2 ways to get a bull trend: double bottom, wedge bottom, and then here, gap up. We have a double top, and then the start of a bear trend. Here we get a wedge top and the start of a bear swing. So these are the things that happen 80% of the time. One of these 4 things: double bottom or double top, wedge bottom or wedge top. 20% of the time, you simply get a trend from the open bull trend, either a bull trend that just keeps going up all day or a bear trend that begins on the first, second, or third bar and trends down all day. Not likely to get a trend from the open bear trend after this strong of a reversal. So more likely, if we sell off, we'll find support around the 60-minute moving average. The 5-minute moving average is going up quickly. Every bar we add here replaces a bar from 20 bars ago. So we're substituting low price bars for high price bars, and the average price goes up very quickly. So for the bears, it's a failed breakout above a bull channel. It's a wedge, 1, 2, 3. Possible high of the day. We broke above the Globex range. 90% chance you break out of the Globex range. Sometimes you break out at the top and below the bottom, but only 10% of the time does the day session stay within the Globex range. Here's the Globex high, here's the Globex low. So for the bears, it's a top, but not a very convincing one. So what they see is this: a wedge, 1, 2, 3, and a failed breakout above the 60-minute moving average. And it's a reasonable short if the bears get a good sell signal bar. By good sell signal bar, I mean a bar pretty much closing on its low. Even if the bears get what they want, we're still probably going to get a trading range. So it's probably not going to be a big bear trend day. Right? 80% chance we're going to have some kind of a trading range over the first hour, first 90 minutes. Okay, so always in long bar 1. Bar 2, no bear body, so a bad sell signal bar. That means buyers below 2, buyers below 1, buyers at the 60-minute moving average, right? So not a very good sell, but it's a problem bar for both the bulls and the bears. The bulls wanted a second consecutive big bull bar closing on its high. That would increase the chances of a strong bull trend. The bears wanted a good sell signal bar, and they did not get it. So bar 2 is bullish because it's not a bear bar. However, it's a warning that this is probably going to be an early trading range. Disappointing for the bulls, disappointing for the bears. Disappointment usually is a warning that the market is confused, and when it's confused, traders are unwilling to hold on to positions. They tend to sell high, bidding against a bull trend, and they tend to buy low, bidding against a bear trend. So it might be a limit order market. There are bears who sold that one high. We have a big gap up, a bull bar closing on its high, and bears sold that high. They sold the close of one, they sold the high of one, they sold 1 point higher, they sold 2 points higher, and they made money. So here we have a very strong bull trend and a very good bull bar, and the bears made money. Okay, would you expect that if the trend was a very strong bull trend? No, and therefore there's a problem with the bull case, and there's an obvious problem with the bear case. We do not have a good sell signal bar, and we have a pretty strong rally. So limit order open right now. Traders are waiting for consecutive good bull bars or consecutive good bear bars, and most traders believe the market is probably going to be mostly sideways for the next hour. This is about 15 bars or so. This is about an hour, right? This is this is less than an hour, but it took about an hour to get there, right? So traders expect confusion for the next hour until we're closer to the average, and we might have to come down to the 60-minute moving average as well. This is rising quickly, so within 4 or 5 bars from now, it'll be up to the 60-minute moving average. So can you sell below 3? 2, not a good sell signal bar, but if 3 closes on its low, it would be a sell signal for a failed breakout above the 60-minute moving average and a parabolic wedge, 1, 2, 3. But probably a lot of limit order trading. Can you buy the low of 2, arguing we don't have a bear bar, 1 and 2? For me, it's too far above the moving average to buy the low of 2. We're always in long, but where's your stop? Do you put it below 1? Well, there are buyers below 1 as well. So do you really want to stop out of a long below 1 when you know bulls will buy the 1 low? So your stop is probably way down here, and you don't want to be risking 15, 20 points, and therefore it's not a good long. And for the bears, if they sell below 2, where's their stop? Probably above 2. The risk is not great, but the probability is not very good either. So limit order trading. The bears made money selling above a good bull bar, 1, and the bulls made money buying below a weak sell signal bar, 2. Better to wait. For the bulls, a high 1. We have a bull trend, a pullback. So 3 is a high 1 bull flag. If it closes on its high, it's a credible buy signal bar, but most traders do not want to pay this far above average. Think about it. If you're desperate to buy a car and the dealer is selling the car for far above average, do you really want to buy the car? No. And the same thing here. This is far above the average price, and traders do not want to pay that much. Always a long, high 1, buy above 3. It's a high 1, buy above 4. But limit order market so far, and only 1 bull bar the first 3 bars. So despite the gap up, only 1 bull bar. So I think fairly tricky trading. If 4 closes on or near its high, a lot of the bulls who buy above 4 will put a stop below 3. But I think the math is not all that good, except for limit order trades. For stop order traders, the bears need a second sell signal. Right now they have the first one below 2. You can say micro double top down on 3 and then up on 4. So if we fall below 3, that would be down. So that would be a micro double top. So credible sell below 3. For the bulls, a high one, but a bad buy signal bar. And probably limit order bear scalpers selling above 3. Can you buy above 4? You would have 2 bull bars in the first 4 bars. Is that far above average bullishness? No. So a lot of the bulls will not buy above 4. But on these opens, you can still rally several bars here. We went up 3 bars here. Here we went up 4 or 5 bars, right? So, it's still okay, but the math is not all that good. Bulls trying to erase yesterday's bearishness, like here, a bear pullback and then a huge bull day, a bear bar. The bulls are hoping to get another day like this. That was January 4th. This is January 4th. We had a big bear day, and we gapped up and we rallied. This is when it became clearly bullish. Surprisingly big bar. The bears will want a second sell signal, 1, and then maybe below 5 or 6 or 2 for a possible high today. And the bulls are trying to get, they got to close above 2. That's good, right? So it's still always in long. We have a magnet above yesterday's high. But if you buy above 4, your stop is down here, and you're risking 7 points, $350 a contract. Do you want to be paying that much above the average price, risking that much, given that we've only had 2 bull bars in the first 4 bars? I think the math is probably not worth it. Bears are hoping for a low 2. So 1 reversal down and then a second reversal down. If you take the sell, it's usually better to wait for a bear bar closing on its low. This is another example, pretty big gap up sideways for the first hour. Similar to today, we have a bear bar, pretty strong rally, and then a second bear bar. If we get that, it would be a credible sell. One thing today that's different here is we have the bear bar today, but we did not go below it. We have a bear bar on 3, did not go below it. And that's a sign of strength on the part of the bulls. And it reduces the probability of bears selling below 5, making money. So this is probably going to be a wedge type day. 1 pullback, 2 pullback, 3. So 1, 2, 3. 3 legs. Gap up is 1, then pullback, and then 2, 3. This is subdivided into a smaller wedge. 1, 2, 3. So there's a wedge within a wedge, but overall it's I would say 1, 2, 3. See, we have a bear bar, did not go below it, so traders were hesitant to sell here. A lot of them wanted a third sell off. So this is similar to today. A bear bar did not go below it, and you end up with a wedge. Small wedge, down, up, down, up, down. Now, what about the bulls who bought above 4? What are they thinking? They're thinking, darn, it looks so good. I thought it was going to go up. I have my stop below 4, but I really didn't expect it to hit my stop. So it's still always in long. However, if 5 closes below its midpoint, most bulls will get out. If 5 does not close below its midpoint, the bulls who bought above 5 above 4 were buying for a swing, they probably will hold long and keep their stop below 4, hoping that we get up above yesterday's high. For the bears, they want 5 to close near its low. I don't know if you noticed, 3 is not a good buy signal bar, and therefore bears will sell the 3 high and sell more higher. They need 5 to pull back below the 3 high. That will allow them to get out break even on their first sell and with a profit on their higher sell. Hard to see, but that's exactly what happened. The 5 low is below the 3 high. So the bears have sold the 3 high. They sold more, 1 or 2 points higher. They made money on their second short. They get out break even on their first. And part of this bounce is bears buying back their shorts. Right? They have limit orders to buy at that 3 high. This resizing TradeStation is really, it makes me mad that they did not have traders provide advice on the features. I spent a lot of time working with the software guy who developed TradeStation 9. This is more than 5 years ago, and he incorporated a whole bunch of things that I told him. And this time, nobody asked me for anything, and this is what we have. All right, so it's a low 2, but not a strong sell signal bar, so we're still probably going higher. This is probably going to be an attempt at a wedge. There probably are more buyers than sellers below 5. It's a possible high of the day, but most bears want to sell below a bear bar closing on or near its low. 5 has a big tail, so probably not a lot of bears willing to sell below 5. If 6 closes on its low, bears will sell below 6, but right now we're still always in long, and we're probably still going a little higher. Because of the reversals, we do not have consecutive bull or bear bars yet today. Here we are, 6 bars into the day, and no sustained buying or selling. And because of that, I suspect we're going to trade below 5. But I think there'll be buyers below 5, and I think we're going to get one more push up. I think the bears are going to try to get a wedge. Bulls still hoping that this is going to be a trend from the open bull trend day. 20% of the days, about once a week, the first bar is either the high or low of the day. That means 4 days a week, the first bar is not the high or the low. So 80% of the days the market goes above and below bar 1. Credible high of the day. Second failed breakout above the 60-minute moving average. Do I think it'll be the high of the day? I don't know. It's a credible top. Bulls get out. We have consecutive bear bars, 5, 6, and 6 is closing near its low. Some bears will sell below 6. Others will wait to see if 7 closes on its low and then sell below 7. And bulls, they do not have to get out. They can keep a stop below 3, but this is the second sell signal. So, and it's a bear bar, 6, so a lot of the bulls will get out below 6. This is what I was talking about, that this looks like a wedge type day because 4 did not go below 3. The bears were not all that strong. So it looks like we're going at least a little bit higher. The bulls are trying to break above yesterday's high, and they want today to be similar to this day, daily chart. Bears try to get a reversal. Bulls broke above the bear bar and rallied strongly. So the always in bulls who did get out below 6 have to buy again, either above a bull bar, 7, or above the high of the day, 5. However, I still think this is going to be a wedge, and that after one more push up, we'll start to go sideways to down until we get closer to the moving average. You can see the moving average is rising faster than the price. We're not that far above the open, but the moving average is very far above the open. of the average. So another high one, pullback in a bull trend, but probably a third leg up and then a wedge. You can see how it popped above 5, jumped several ticks. The bears who sold below 6 got out, and the bulls who get out of longs below 6 got in. If it's going to get a decent bear bar 8, that would be a higher probability sell, an IOI, and a low 3 and a wedge. Remember, I talked about the market trying to get a wedge rally or a double top, and this is looking like a possible wedge. We might still get closer to yesterday's high. Is the probability high enough for a scalp below 8? If 8 closes on its low, it probably is, but most traders selling below 8 will probably be looking for a swing. For the bulls, I think if they did not get out below 6, they will get out below 8 if 8 closes on or near its low. I never like big signal bars because the risk is big, and if you're shorting, you're betting against a bull trend, and the probability is not as high as you want. So this is not an ideal sell setup. However, it's a reasonable sell setup if 8 closes near its low. So 1 or 2 tick tail below, yes. 3 tick tail, maybe. 4 or 5 tick tail, probably better to not sell. 4 tick tail below 8. It's a credible candidate for the high of the day. Longs, I would get out of longs below 8. I think it's okay to sell it, but it's a 5-bar tight trading range, and selling at the bottom of a tight trading range is not a high probability bet. So the bears have a trade that does not have particularly high probability, and because 8 is big, the risk is pretty big. So it's not a strong sell. And for the bulls, we have 8 bars today. We do not have consecutive bull bars. And if the trend is strong, if the bull trend is strong, don't you think we would have consecutive bull bars at some point? So therefore, this is not a strong bull trend. If it's not a strong bull trend, do you want to be paying this far above the average price? So problem for the bulls, problem for the bears. I would get out of longs below 8. A lot of the bulls who get out below 6 did not buy above 7. They wanted above 5. They wanted to buy above the bull bar 7, but we did not go above the bull bar. So a lot of the always in bulls are still flat. This is a swing short below 8, taking a chance we go to a new low of the day and down to the moving average. That triggers the swing short for the wedge top, but 6-bar tight trading range, 5-bar tight trading range, probability is not as good as the bears want. Bulls hope for a micro double bottom, 7 and 9. They want 9 to be a pretty good buy signal bar. The bears who sold below 8 are swing traders. Their stop is above 7. Bulls, I think they get out here. What happens if 9 closes on its high and becomes a pretty good bull bar? I think most of the bears would probably, well, I don't know, if it's a really strong bull bar, they'll get out above 9. Otherwise, they'll get out above 7. And for the bulls, I think a lot of the bulls do not want to pay this much above average price for this kind of price action. And therefore, unless 9 is especially strongly bullish, most bulls are not going to buy above 9. They bought above 3, a bear bar, right? But I suspect there are sellers above 9, and that will go sideways to down to the moving average and the low of the day over the next 5 or 10 bars. Surprise bar down, surprisingly big bar, represents bulls giving up. If it closes on its low, we'll probably get at least a little bit more down. for example, new low of the day, and test of the two moving averages. "17 ticks below 8, so you'll have a lot of bears taking partial profits at 4 points. It has to go 18 ticks, which it just did. So you might get some buying here, some little bounce, but always in short at this point. 3 consecutive bear bars, pretty good bear breakout bar. For the bulls, they want a double bottom near the moving average. I talked about this earlier, that when you get a gap up, the bulls try to get a double bottom or a wedge bottom. Here's a double bottom, 8 bear bars, still low of the day. Here's a new low of the day, test of the moving average, test of the moving average. So the bulls still have a chance of a bull trend day. Right now, this is what the bears have. They have a wedge top and a breakout. Here, we're far below the moving average. Today, we're not. Today, we're still above the moving average. You can see a lot of the bears taking partial profits. I typically take, I get out completely here because of the possibility of a double bottom. Can you buy above 11? Double bottom 1 near the moving average? I would not. Surprise bar 10, probably at least a small second leg sideways or down. And you're still buying above the average price for price action that's really not above average. We have a lot of bear bars here, 5 bear bars, 6 bear bars in the first 10 bars. So the most bars are bear bars. You have 3 consecutive bear bars. Do you really want to be buying above the average price? Probably not. So not a good buy above 11. We're working on the appearance of the first hour. The bulls have a rally. We have a bear trend and a bull trend. So it's a bull flag, bear breakout. Not a strong buy signal bar, not a strong entry bar, tail, gap up, but not a good follow through bar. Remember I said we're going to get a minor reversal up, a lower high. And the bears are trying to create as strong a sell signal bar as they can. They want bar 12 today to close near its low to make this 60-minute bar a better sell signal bar. This is bar 11 right now. Always in short, but in the buy zone near the moving average. With the 4 bear bars, most of them closing fairly close to their lows, bulls will want a micro double bottom. So yes, double bottom 1, but 4 bear bars, probably not a lot of buyers above 11. Is it sell to close? Well, yes, but we're right above support. So it's probably not worth selling below 11. Running out of sellers down here. We're at the moving average. Traders are hesitant to sell into support, even though we're always in short. Gap up wedge became the high of the day. Similar to today, became the start of a swing down. Got a swing down. Spread over a couple hours. When it's this late in the day, I don't think of it so much as a opening reversal as a reversal day. Once it gets into the middle third of the day, if you get the reversal, I think of it more as simply a trend reversal day. Wedge, wedge, wedge. This is the end of the first hour, and you can look at the 60-minute bar. We still have a minute left. Right now the bar is at its low, closing on its low. We could still bounce into the end of the hour in the final seconds, making it a weaker sell signal bar, but right now it's a decent sell signal bar for the bears. the moving average, 60-minute moving average, it's around a 50% pullback. Can you simply buy here and make money? Probably, right? Pulling back to the moving average, around a 50% pullback from yesterday's close. I would not do it. I think we're always in short. And by the close of bar 12, 70% chance we've seen either the high or low of the day. And right now, we've probably seen the high of the day. The bulls were hoping that on the daily chart, today would be like this: big bear day, big bull day, big bear day. They could not get above yesterday's high, so not big bull day. It's sell to close, but we're right at 2 moving averages, and I'm flat. I did not sell. And to buy, I want to see some bull bars. I don't want to be buying when there are a bunch of bear bars. I need the bulls to start. They have to stop the selling. They have to make it go sideways before I'll look to buy. That's triggering the sell on the 60-minute chart. For the bears, they're hoping this is the start of a bear trend, and this is a pullback, a low one bear flag. Most likely, big up, big down, big confusion, and sideways. So instead of this being a lower high major trend reversal on the 60-minute chart, we're probably going to go sideways. This, or this. This is probably what the day will look like. Stop for the bears is way up here, and that's a lot of risk, and we're at support. A lot of bears will take some profits here, and it could result in a bounce. Stop order bulls, will they buy above 13? There are bulls buying at the 5-minute moving average, at the 60-minute moving average, with limit orders below bars, but they're scalping. They're just trying to ride the short covering. They know bears will take some profits at support. They know there's a small chance that this is the low of the day, a double bottom one, a lower low double bottom. Remember I said that we might get a double bottom at the moving average. And a lot of times the sell-off is strong. So here we got a bunch of bear bars. We have a double bottom, slightly higher high double bottom at the moving average. And we got a big bull trend. A lot of bear bars. When you have that many bear bars, a lot of bulls wait for some kind of a double bottom or a micro double bottom before buying. I think today is going to be mostly sideways. 8 bear bars bought, a reversal at the moving average. Bulls bought, got a swing up. Even though it's swung up, it's still mostly sideways. This closed around this earlier high. But this is the kind of thing that we might get. If we do rally, we'll probably not end up with a big bull trend day. A lot of bear bars, double bottom at the moving average. A lot of bear bars, yet became a small pullback bull trend. So why am I talking about a trading range? Because of this 60-minute chart, big up, big down, big confusion, and then we got a bounce. So I think the market's confused and will probably go mostly sideways today. Daily chart, what have I been saying since yesterday started? I said parabolic wedge top, 1, 2, 3, typically results in an endless pullback and a lot of confusion. Tight trading range tilted down somewhat, a lot of trading range trading. And if you have a lot of trading range trading on the daily chart, you tend to get a lot of trading range trading on the 5-minute chart as well. So we triggered the sell on the 60-minute chart, but instead of the market collapsing below the sell signal bar, we're bouncing. So this is probably what today will be look like. A lot of sideways overlapping bars. This. For the bulls, double bottom one, but 5 bear bars and a doji bar. So bears will sell the 13 high, put a stop above 7, and sell more higher, betting that even though it's a double bottom at the moving average, it'll be a minor reversal up. And bears, bulls, they'll take a chance that we'll get a wedge bottom. So 1, 2, 3. So some bulls will buy above 13. We have a double bottom, and put a stop somewhere down here, thinking that maybe we'll get one more leg down and then a big wedge bull flag. So 1, 2, and 3. Confusion, right? Confusion usually results in a lot of trading range trading. For the bulls, I would wait for a micro double bottom and a good bull bar before buying. And for the bears, it's always in short, but we're at support, 2 moving averages, and we're only around a 50% pullback. So, and the stop is far away, so it's probably better to look to sell a rally. Or if we break strongly to the downside, you could sell lower, but more likely it's going to be better to sell somewhere up in here. Best choice for most traders, flat. We're still short below 8, so we have not gone above a bar, 13. So the bears could theoretically still be short. Do they have to get out above 13? We've probably seen the high of the day, so you could keep a stop above 7 and just hold on. But I would get out above a bull bar. So if 14 is a bull bar, especially closing on its high, I would get out of shorts. I would get out maybe 4 ticks above any bar, including a bear bar or a doji bar, 13. And then see what the rally looks like, and then look to sell a lower high. Maybe 4, 5, 6 bars from now. Bulls are hoping for a wedge bull flag, but we have too many bear bars, so they're hoping for 3 legs down or high 3, high 1, high 2, high 3. But today we have too many bear bars. There's another version. A lot of bear bars. The bulls did get a wedge bottom, 3 bottoms, 1, 2, 3. Higher probability to buy after you start to see several bull bars and then bull bars closing on their highs. Strong bear breakout. Most bulls will wait for a second buy, which is a wedge, high 1, high 2, high 3. Well, can you buy with the limit order 60-minute moving average? Can you buy at the 13 low? I would not. I think we've seen the high of the day, and the bears selling below 14. It's tricky. A lot of the bears will scalp out because we're at the 60-minute moving average. So it's obviously an okay swing sell, but I think a lot of the bears who sell below 14 will scalp out. It's still sell the close, but I'm flat. We're getting an extreme number of bars down, and that increases the chances of profit taking, short covering. Comparable to the daily chart over here. Once you start to get a lot of bear bars, 6, 7, 8 bear bars, there's a risk of an abrupt short covering rally. Yesterday's close is always a magnet. 50% pullback is always a magnet. And the 50% pullback is here. Yesterday's close is here. We broke above this high, and we're testing the high. We're testing the 60-minute moving average. Some limit order bulls at the 50% pullback, hoping for a bounce. We're very close to yesterday's close, so I suspect we'll get there even if we do bounce here. Bears, I would get out above a bull bar and look to sell again higher, maybe around the one low, a 50% pullback. We have a bigger bar, 15, so a climax. And for the bulls, we're probably going to get a bounce. However, stop entry bulls buying above 16, it's probably better to wait for a micro double bottom. Here we have, what is that, a 9-bar bear micro channel. A lot of times around bar 18, the market tries to reverse, even if there's a strong sell-off. By the close of bar 16, maybe 80% chance we've seen the high or low of the day. By the close of bar 18, 90% chance. By the close of bar 40, bar 50, probably 95% chance. By the close of bar 80, 99.99% chance we've seen either the high or low of the day. Every bar that gets added increases the probability that we've already seen the high or low of the day. So I would get out of shorts above 15 because we could get a pretty good bounce, maybe up to the one low. You can see we're at a 50% pullback, 60-minute moving average. If we bounce 50%, that takes us back to the one low. So this is a measured move down from the high to the one low. So there is some support here. Now I'm putting a breakout above the 18-bar range because sometimes you sell off for the first 18 bars. The blue box is the first 18 bars. And then you reverse up here at bar 17, and we did not break below the 18-bar range. Instead, we broke above. So that's why I'm showing this. Sometimes you get an early sell-off, but instead of breaking below the 18-bar range, you break above it. So a lot of times you get reversals around bar 18. Big sell-off, and then early low of the day. Sell-off, early low of the day. We do not have to break out of the 18-bar range, but probably 80% of the days we do. So 80% chance we're going to break out of the current range, and more likely we'll break below the bottom. You can see there's definitely some buying, right? Because we're around bar 18, a lot of times the market makes a decision around bar 18. Are we going to reverse or continue? Bears, I'd get out above any bull bar, even a one-tick bull bar, and wait to sell higher, a couple legs up after a sell climax. You can call it a parabolic wedge, big bear bar, small bear bar, so pause. So leg 1, pause, leg 2, pause, and leg 3. Not a good buy signal bar, but we're in a support zone. Yesterday's close, 60-minute moving average, 50% pullback. Bears are hoping that we just trend down all day. When you get a lot of early bear bars, this is a gap down. I want to do a gap up version. Gap up and then just sold off all day. This is what the bears want. Early high of the day and then sell off all day. The more bear bars you get early on, the more consecutive bear bars, the more likely you're going to get a swing down. Bulls still hoping for a parabolic wedge different ways to draw it: 1, 2, 3, or 1, 2, 3. Testing yesterday's close. Is it a still sell to close? It is, but we're pretty late in the trend. This is now 11 bars in a microchannel, starting bar 7. That is extreme. You can get more. Sometimes you can get, remember I moved it around here. $22 bars, every bar with a high at or below the high of the prior bar. So, 11 sounds like a lot, 12 sounds like a lot, but here we have 22 bars before we finally get a reversal. When you have that many bars down and you get a reversal, the reversal is typically minor, which means it leads to a trading range. Here, 19 bars before we get a pullback, and it ended up being a double top bear flag, and then we got another leg down. Okay, testing near yesterday's close. We're very close to it. You can see we're up only 2 points. We're probably going to get down to yesterday's close. Is that close enough to yesterday's close to be an adequate test? Don't know. However, I do know that this is a lot of bear bars. When's the last time we had a bull bar? Bar 7. And therefore, any reversal here will probably be minor and form a lower high, a bull leg in our trading range and not a bull trend. This is bar 17. The market often tries to reverse around bar 18, but with this many bear bars, the odds are we've seen the high of the day, even if we reverse up. Still sell the close, but tail 17. I would not sell below 17. Also, a lot of times the market tries to reverse around bar 18, and I think at this point it's probably better to look to sell higher. And for the bulls, they could probably make money buying at the market, buying above 17, but I think it's better to wait for the market to go sideways and start forming bull bars before buying. And even then, the buys will probably be scalps. The first buys will probably be limit order scalps, buying below a bull bar, for example. Right now, I think it's better to be short and getting out of a short, maybe a point above any bar or a tick above any bull bar, because the odds are we're going to get some kind of a bounce. We still have not reached yesterday's close, and the bears are still trying to get it down there. Micro double bottom, so that's good for the bulls, and the bears are trying to get down to yesterday's close, and we got close twice, and it looks like we're bouncing both times, so this could be the start of a little bounce. This is bar 18. Again, the market often tries to reverse around bar 18, but we now have maybe a 12-bar bear microchannel, so any reversal we get will probably be minor. What are the chances that we get to a new high of the day? Well, right now, probably 10%. So 90% chance either today remains a bear trend day or it enters a trading range. Can you sell the 18 high, 12-bar bear microchannel? I would not. I would wait for a couple legs sideways to up, maybe to around the moving average, maybe up here, and then look to sell. For the bears, it's another low one, a pullback in a bear trend and a magnet below yesterday's close. You can see 12-bar bear microchannel, bear bar 18. Some bears did sell the 18 high, looking for at least a scalp. It fell 5 ticks from the 18 high and then stopped. Tells you that a lot of the bears who sold the 18 high were scalping for 1 point, and that's a sign of a lack of conviction. What about selling outside down below 18? It's still always in short. There's still room to yesterday's close, but this is getting extreme, and bears will start taking profits before long, and that'll make bears hesitant to sell down here. They'll look to sell higher. Everybody's wondering, are we going to get short covering here, or do we have to go a little bit lower? Bulls, not a great stop entry buy. The bears, I'd get out either 1 point above any bar, including a bear bar, and 1 tick above a bull bar. Remember, the market often tries to reverse around bar 18, but 12 bar bear microchannel, probably minor reversal, which means a lower high. Now, bears, I think it's reasonable to get out here above 18, above 19. And if the bears get out, are they going to sell again below 20, a low 1? They can, but a lot of the bears who are taking profits will probably wait for several bars before thinking about selling again. And therefore, there may not be a lot of sellers below 20. We're always in short. If the bears get out, they have to sell again if they're trading always in, and they want to sell below a bear bar closing near a slow. But this is excessive, extreme, unsustainable, and therefore climactic. And if you have a sell climax, a lot of bears will not sell the first attempt to resume the bear trend. They'll wait for a second attempt, so a low 2. And therefore, selling below 20, a low 1, probably not worth it. Bulls hoping low of the day, reversal at bar 18. However, it's probably a minor reversal. It could go up a lot of bars. We have a micro triple bottom just above yesterday's close, but it's still probably a minor reversal and only 10% chance we're going to get a new high. Therefore, even if we rally for the next hour or so, we're probably not going above the high of the day. The best the bulls probably get is a trading range. Bears trying to get a low 120, but unless it closes on its low or very close to its low, most bears are not going to sell. They'll wait for maybe a low 2 at the moving average. Bears low 1 to a pretty prominent tail, and probably more buyers than sellers below 20 and below 19. Can you sell on a stop below 18? That would be a breakout below the 18 bar range. I think you can only do it if you can use a pretty wide stop. How many bars up do bulls need to see before they're convinced that this is the low of the day? A lot. Right now, only 10% chance we're going to a new high. And we're probably going to be spending a lot of time sideways. I said that on the open, and I still think that's true. Big up, big down, big up, confusion. The bulls are hoping for bear trend, bull breakout, higher low, major trend reversal, but 12 bar bear microchannel, first reversal probably minor. It could be big, it could be 50% pullback, testing one low, but probably a lower high. The bulls will probably need some kind of a double bottom before they can get a bull trend. Trading range trading, limit order bears sell this 18 high and scalp, and limit order bulls, well, they buy the 21 low. It's 2 legs up, 19, 21. This looks like trading range trading, and limit order trading, probably buyers below 21 and buyers below 19, low of the day. And a lot of the bears will want a low 2. This is a low 1. On a smaller time frame, it's a low 2. We went up, down, up. But on this time frame, it's a low 1. So this is not good for stop order traders right here. Bulls probably should wait for some kind of a double bottom. Bears probably will wait for some kind of a double top, which means several more bars before a good stop entry trade. This is bar 22. We're getting near the end of the second hour, bar 24, and you can see the second hour right now has a fairly prominent tail, not a strong entry bar for the bears who sold below the first hour. Remember, I said that we're probably going to be mostly sideways today. For the bears, this is a deep pullback, but probably a 50% pullback from this. Remember yesterday how abrupt and big the reversals were, trading range trading. This is probably a continuation of it. Bears trying to get a breakout of the 18 bar range. They're trying to get below 18, but we're starting to get a lot of sideways bars, big tails, small bodies. And while the bears can sell for any reason, including below 18, I think we're probably in the early stages of a trading range. And therefore, I think we're probably not going to go much below 18, at least not for the next several bars. So in other words, we go below, we trigger the sell, and then maybe go down for a bar or two, and then start to go sideways again. Bears are hoping for a big break below the 18 bar range, but it's so overdone right now that we're probably not going to get a big break below, and we'll probably get a pullback pretty soon. Here's the 18 bar range, the blue box. We broke below, but wedge sell climax. The breakout did not fall very far before we entered a trading range for the next couple of hours. We tried to break above yesterday's high and failed. The bears would like to break below yesterday's low, but they probably will be unable. So today will probably remain an inside day. Bulls, this would be a better buy if they get a good bull bar 23, but even then, any reversal is probably minor. The best the bulls can probably get today is a trading range. We got below yesterday's close, so you can see we're finally negative. But probably the buy zone, around a 50% pullback. Yesterday's close, a sell climax. Now you get a bigger wedge. 1, 2, 3. I don't know that we'll get a reversal, but I think we'll probably enter a trading range soon. Trading ranges have bull legs as well as bear legs, so we'll probably get a bounce, a pullback back into the 18 bar range. Bulls, they need bull bars closing on their highs. Fairly climactic, third push down, so increased chance of a reversal. However, it's still solid close. I think most of the bears who sold below 21 or below 18 will not hold very long. They'll take profits pretty soon. We're breaking below the 18 bar range, but very often you get a pullback, especially if the sell-off leading to the breakout is excessive. Can we get down to yesterday's low? I think today will probably remain inside of yesterday's range. Very good pair of bear bars, strong enough so we'll probably get at least a small second leg down, but you got to be thinking possible wedge and sell climax. So 40% chance we reverse up above 24. 60% chance we get at least one more small leg down and then a reversal. This is probably the start of a trading range. So not great sell to close unless you can use a very wide stop and scale in higher. Remember I said 90% chance we break out of the Globex range, and sometimes you break out of the top and the bottom, and the bears are trying to get that here. Wedge bottom, sell climax, probable start of a trading range. Reasonable candidate for the low of the day or the low of the next couple hours, but the bulls need a pretty good bull bar. This is the end of the second hour. What do? Well, if you're a bear, you get out above 24. If you're a bull, it's an okay swing buy. Bulls who want higher probability will wait for another 1, 2, or 3 bars to see what we get. But I would get out of shorts above any bull bar. And bulls, if it closes on its high, bulls will buy. The aggressive bulls will buy right here above 24. Other bulls will wait for a bar or 2 more to see if we reverse up. A lot of times in a bear trend, you'll get a good looking bull bar. The market will go a tick or 2 above it and then continue down. So the probability is not yet all that high. Can you sell the 24 high? No, I'd get out of shorts. This is the concern, that in a bear trend, a lot of times the market keeps creating bull bars, yet there are sellers above the bull bars, and the bear channel continues. Do I think that'll be the case here? I've been saying since early on that I thought today would have a lot of trading range trading. I still think that's the case. 24 is a pullback in a bear trend, and therefore it's a low one sell signal bar. But I would not sell below 24, and I would not sell below 25. We have a good-looking buy signal bar. We have a sell climax here and another sell climax here. So I would wait for a couple legs up before looking to sell again. What do the swing bulls do who bought above 24? Well, they could either get out below 24 or buy more below 24. Odds are we're in a trading range. Doesn't look like a trading range yet, but this is probably going to be a trading range. Resistance around the 60-minute moving average. So even if we go a little bit lower, we'll probably come back up here over the next couple of hours. Bulls will scalp, right? They'll be happy to have any profit. I'd be out of shorts, and I would wait for at least a couple legs sideways to up before selling again. A lot of times when you have a trend or a swing, you'll get a reversal attempt at 18 bars, and if not 18 bars, then 2 hours, 24 bars. If not bar 24, then 3 hours, 36. For the bears, another low one short below 25 and below 26. One thing I always pay attention to in these reversals is can limit order bulls make money? There were bulls who bought the 18 bar low, they scaled in lower, and they needed to get above that 18 bar low to make money. So I always pay attention to whether or not they're successful. Okay, you can see the 26 high did not get above the 18 low. So the bulls who bought the 18 low with a limit order and bought more lower, 2, 4, 6 points lower, are still trapped. It did not get above the 18 bar low. That would allow them to get out break even on their first buy with a profit on their lower buy. I still think we're going to get above the 18 bar low, and I still think this is going to end up as a trading range. Several hours from now, we'll look back and we'll see a trading range. Low one, just like 21, but pretty good bull bar 24, and the odds are against today going below yesterday's low. So therefore, probably not going a lot lower. So it's a tricky short. We're still always in short. Theoretically, the bears have to sell again, but with a wedge bottom, I typically wait for a couple legs up before selling again. So I would not sell below 26. I'm not going to sell below 26. The bulls are hoping for a wedge bottom and a reversal up. If they get the reversal, we'll probably be in a trading range and not big bull trend. Big sell-off on the open around bar 18, bar 24, around where we are today. Bulls got a reversal, but they were unable to get all the way back to the high of the day, even though it rallied for 4 hours, unable to get a new high of the day. And that's probably true today as well. 90% chance we're not going above the high of the day. So we could rally for the next 4 hours, but probably not going to a new high. Musical chairs, right? Do you hope the bear trend continues or and sell below 26, or do you wait for a couple legs? I would wait for a couple legs, especially if 26 has a fairly prominent tail, like a 4-tick tail, that would increase the chances of more buyers than sellers below 26. Now, why are we hesitating? Why are we not dropping below 26? It's a low one and a bear trend. It's because traders are wondering, are we converting into a trading range? And if it's a trading range, will there be more buyers at the 26 low than sellers? Which I think there will be. I think there'll be buyers below 26 and below 24. And that will start to enter a trading range. Probably limit order bulls buying 26 low, 25 low, scaling in lower and scalping. And they've already made their money. And bears, they're going to keep pressing shorts, but we have a wedge bottom 24, a weak sell signal bar 26. I would rather wait for a couple legs up to around the moving average before selling. A lot of bulls do not like to buy a tight bull channel 24. They wait for a second buy signal, and they'll hope to get it on maybe 28 or 29, a second buy signal bar. That would be a higher probability buy. And the buy would be a minor reversal. Unlikely to get a bull trend after this much selling. I'm trapped out. I'm looking to buy a second reversal up, but these two bear bars are big enough to make me not eager to buy unless we go sideways more. And for the bears, I did not sell. I did not do anything below 20. I did not buy, did not sell. So right now, I have not done anything in the past several bars. Can you sell on a stop below yesterday's low? I would not. Right now, I'm looking for a rally closer to the moving average and a couple legs up to sell, or for it to go sideways for several bars and create decent bull bars to buy. But this is very strongly bearish, and I really needed to go sideways more to buy. So right now I'm trapped out. Testing the buy climax low 78. Testing yesterday's low, the buy climax low 74. Let me take a look at ticks. Very low greeting in ticks, probably not the final low of the day. We have a new low in ticks, even a lower low. Is there anything the bulls can do 29 to make me buy? Probably not. They would have to have a very dramatic reversal, very, very big bull bar. And for the bears, it's still sell the close, sell the low, but you're selling fairly far below the moving average, and 3 pushes down. Now 1, 2, 3. Whenever you see a reasonable buy setup, 24, yet the rally 26 could not go above the breakout point, could not close the gap. You have trapped bulls who scaled in and break to the downside. Whenever you have a gap, whenever this bar, the pullback does not overlap the breakout point, there's a gap. Right now, there's a small chance of a measured move down there. 15-minute chart takes us down there. However, whenever I see these gaps like that, the bulls should have been able to get it above the 18 low and unable. And whenever I see these gaps, I'm always thinking that the bears might be a lot stronger than what they were likely to be early in the day, and therefore we may go down for that measured move. Right now, I've trapped out. The sell was below 21, below 27, below 28, and I did not take either. Probably some buyers around yesterday's low and around the 74 low. The market reversed up strongly from this price level yesterday, but really nothing to buy. 3 big bear bars. Most bulls need at least a micro double bottom. Bears, they'll get up above any bull bar and maybe a point or so above any bar, including a bear bar. Picks minus 1,000, usually not the final low in price. So even if we bounce for 5 or 10 bars on the 1-minute chart, we're probably going to get a new low in price. We have a wedge bottom 24 and a big bear breakout. When you get a big bear breakout, typically you get a couple legs down before the bulls will have a reasonable chance at a reversal up. So buying above 30, not worth it. What happens if we get 3 or 4 consecutive bull bars? Then maybe I'll buy closes. But without that, I would wait for a second buy signal. Because of that gap, I'm going to draw in the measured move projection. Bulls trying to get a perfect double bottom. Yesterday's low. But too many bear bars. Better to wait for a second buy signal. Sometimes you get a perfect test of yesterday's low, like this, and then a reversal up. Another one. Test of yesterday's low here. We hit yesterday's low exactly to the tick and get a reversal. So several examples of a big sell-off down to around yesterday's low and then reversal up. Okay, we broke below yesterday's low. You can argue wedge 18.24, but you can argue test of yesterday's low, but a doji bar 30 and a lot of big bear bars. I would wait for a micro double bottom and a pretty good bull bar before buying. Can you sell the 30 high? I would get out of shorts above the 30 high. Whenever you test yesterday's low, you can get a fairly big reversal. I'd get out of shorts and wait. And for bulls, I think it's not worth buying with a stop. For the bears, a low 1, 31, a pullback from the break below yesterday's low, but climactic. So increased risk of exhausted bears. Possible expanding triangle, a new low, lower low, and higher high. Huge gap below 24, so we'll probably fill in a lot of that gap at some point today. You have limit order bulls above the 26 low and the 24 low. Both are reasonable things to do, and therefore those bears have an 80% chance of making money, or at least avoiding a loss, if they use a wide stop and scale in. And a lot of them look to buy above a strong bull bar, lower down. If 31 closes on its high, the bulls who bought here, a lot of them will buy more here, expecting it to come back to the 24 high or the 24 low area, or at least halfway up, which would allow them to avoid a loss. If I were managing a fund, I probably would buy above 31, use the wide stop, and scale in lower, betting that we'd go up more. I say that, I don't know. I don't like to buy a first reversal up after this many big bear bars. I probably would wait for the second buy. And for the bears, 31 is a pullback from the break below yesterday's low, so it's a low one sell, similar to 21 and 26. Neither one a very good sell signal bar, but both were profitable sells. Well, I'm trapped out. I don't want to sell below consecutive bull bars, especially having a pretty good bull bar 31, and I don't want to buy when a bear trend is this strong, so I'm stuck on the sidelines. That pink line is the measured move from this gap. Remember I said we had ticks down to minus 1,000, the red line, and that's usually not the final low in price. If it's the first time that we hit that extreme a tick level, normally you might rally for 5 or 10 bars, but you typically get a new low in price, but it often comes with a higher low in ticks, so you get a divergence. So fewer stocks are going down. Volume is getting bigger. Typically you get less volume if you're going to get a reversal. And instead we got more volume. It's possible that it's just climactic. And we've had a series of sell climaxes. Little one here, bigger one here, little one here, bigger one here, bigger one here, another one here. If the bulls get an inside bar closing on its high, that would be a second buy signal, failed breakout yesterday's low, and that would be a higher probability buy. That would be one that I would consider. If we get a rally, it's unlikely to be a strong bull trend. It'll probably be a bull channel, and it'll keep trying to reverse down, but work higher for several bars. So the bulls have the potential for a 5 to 10 bar weak rally over the next hour. It's important to see that limit order bulls who bought the 31 low and bought more lower made money. Bulls who bought yesterday's low and bought more lower made money. That's the first sign that the bear trend is losing strength. Limit order bulls are starting to make money. Not quite to the measured move target. And since we're very close to it and the selling is strong, you got to think we probably have to get there. Even if we bounce 5 or 10 bars first, right now I think we'll get down to the measured move target. We could go a lot lower, but at a minimum, I think we'll get there, even if we bounce over the next hour. Remember, 27, 28, surprisingly strong. Odds were we would get at least a small second leg down. 32 qualifies as that minimum objective, but the bulls need 33 to close on its high. Otherwise, bulls will wait. And for the bears, it's another low one sell. We've had several with sell signal bars that are not very good, 21, 26, 31, yet the shorts were all profitable. Odds are the selling is going to stop around here. Yesterday's low, support, and then a measured move. So we're probably, I thought we were going to enter a trading range 24, broke to the downside, break below a wedge, you expect at least a couple legs down, Well, we have the 2 legs down. The bulls tried to get a bottom here. Now they're trying again here. So it's consecutive bottoms. Tried to get a bottom here, failed, and now trying to get another bottom here. Tried to get a wedge bottom, got 2 more legs down, and then bottom. Not a strong rally. You can see bad follow through, right? So if we get a rally, it'll probably look like this. Tried to get a bottom, failed. Then we've got a second bottom, breakout and a second bottom. Tried to get a bottom, failed, breakout, and a second bottom. Strong second leg down. So similar to today. Strong breakout, and then a second leg down. Strong breakout, and then a second leg down. Bears, I'd get up above a bull bar. And bulls, if 33 closes on its high, it's a reasonable buy. Second failed breakout, yesterday's low. But it's going to be a minor reversal and probably lead to a trading range and not much of a bull trend. If the bar does not close on or near its high, I would wait. Well, got my finger on the button and did not. I'm not placing the order. It's not good enough for me. So the bears are low 1, but bulls made money buying below 31 and 30. They'll probably buy below 33 and 32 and at the measured move target. So the bears, a tough low 1 short. We're at important support. We have consecutive bottoms. We have a second leg down from an extreme sell climax. Bulls want a bull bar closing on its high, and they would prefer a bar that has a pretty good sized bull body. Bears looks like they scalped the short below 31, and they scalped the short below 33. It went down and up. Bears bought back the shorts, and bulls bought a point or 2 below. We're very close to the target, so I suspect we have to go a little bit lower. Micro double bottom and a small wedge 30-32, but a bear body. Bears, they can get out above 34, or they can get out above a bull bar, or they can get out 4 or 5 or 6 ticks above any bar, including 34. And for the bulls, it's, I think, not a good enough stop entry buy. Basically a trend from the open, bear trend. Relentless selling here. The bulls tried to get a bottom. We still went lower. Ultimately, we get a reversal. This is kind of like today. Just too many sell climaxes. Usually the market ends up going sideways for a couple of hours. Bulls like to see bull bars closing on their highs before they buy with stops. 15-minute chart. Failed breakout yesterday's low. 15-minute chart on the day session. Basically a lower low double bottom, but a very tight bear channel. And therefore, a reversal up will probably lead to a trading range and not a bull trend. However, a trading range could last a lot of bars, like a couple hours. We got to within a couple ticks. I don't have this drawn in accurately. Let me draw it in accurately. You always have to be suspicious when the market gets to within a couple ticks of a measured move target. Okay, so we got to within, looks like 2 ticks of the target. I don't know, maybe a point or so of the target. $11.25. So we got to within 5 ticks of the target. That's not close enough. So odds are this is not the low of the day, even if we rally. Normally it has to get to within at least a tick or so of the target. before traders will conclude the target has been fully tested. And therefore, we still have an untested magnet below. If we get 3 or 4 big bull bars, I'll change my mind. But right now, it's more likely that we have to get down to this pink line before the day is over. Bears, some bears will only get out above a bear bar closing on its high, and that might be bar 35. And the bulls, a lot of bulls will only buy above a bull bar closing on its high. I do think we're going to go here at some point today. Right? Let's say this is a bull bar closing on its high. The skeleton bulls will buy above its high, but let's say it's right here. Some bulls bought that 24 high, reasonable wedge bottom. Their average price is right here. 80% chance, if you do that, you can avoid a loss. That means 80% chance we'll go at least 1 tick above the midpoint of the 2 entries. So this is the buy signal bar, typical trading range behavior. Probability not great because the channel is tight, and the risk is big because you're buying far above the low of the day. However, that is a reasonable buy, especially if you can use a very wide stop and scale and lower. Odds are the bear trend is converting into a trading range. So let me do that again. You got some bulls who bought 1 tick above 24 right there. Other bulls will, and those bulls, some of them will buy more above a bull bar 1 tick above here. Their average price is here. So if we go above 36, 35, high probability, 80%, we'll get up to this pink line. Or if we get one more new low and then another buy signal bar, 80% chance we'll get a rally to the average price. Unlikely to be a strong bull trend. So if we reverse, it'll probably be bad follow through, and work higher in a channel like that. Bear trend, probably transitioning into a trading range, and in a trading range, things tend to get foggy, unclear, and you tend to get bad follow through and lots of reversals. Minimum target, the midpoint between the 2 buys. Probably buyers below 36. Bears double top, bear flag 31, but fairly far below the moving average. And credible buy above 35. You can see a lot of the bulls scalped. It went 10 ticks up and stalled. Why 10 ticks? Because it had to go 10 ticks for the bulls to make 2 points. And because of that tail, 36, it's telling you that a lot of the bulls simply scalped. They do not believe it's a bull trend, but they thought it would go up enough for at least a scalp. For the bears, a double top 31, but if 36 has a bull body, probably buyers below, and we'll probably try to get up to the moving average and that average entry price. What about the measured move target down here? Right now, I still think we'll get there at some point today. The bulls are deciding, or the traders are deciding, has the trading range begun, or do we have to go a little bit lower first? It looks like it's probably begun. Complex consecutive bottoms. Usually results in a trading range. Try to get a wedge bottom, bear breakout. You'd expect a second leg down. We got the second leg down, and a rally, but mostly trading range trading. Try to get a bottom, bear breakout, got a small second leg down, and then trading range for the next several hours. A wedge bottom, second wedge bottom, and the bulls got a reversal, but it only retraced about half of the original sell-off. Strong rally, tried to get a wedge bottom, second bottom, but trading range. Near the targets, 24 low, scaling bulls bought the 24 low. Some bulls bought 24 high and bought more lower, above a strong bull bar 35. So there should be some profit taking around that pink line. It's also resistance, 24 low, and the moving average. Are we always in long yet? Not yet. If 37 closes on its high, then we're probably always in long. However, it's still a minor reversal, and the best the bulls probably get is a trading range. They might get back to the 60-minute moving average and this gap at some point today. Bears still double top 31, but if 37 has a bull body, even a small bull body, probably buyers below despite the double top. Odds are we're going to go up a little bit higher. You know, can you argue the bulls bought above 34 instead of above 35? Some did, and they've already gotten out, right? They bought above 24, they bought more above 34, and this is their average entry price. And it went maybe a tick above their average entry price, allowing them to get out break even. But I think most of the bulls who bought above 24 who are scaling in lower would like to buy above a bull bar closing on its high 35. So I think we'll go up to that pink line, at least a tick above it. For the bears, double top 31, but probably buyers not far below 37. So low probability short. We've probably entered a trading range. Probably always in long, but also probably a minor reversal. We might get up to the 24 high, the 60-minute moving average, but trading range more likely than bull trend. You can see the bulls have bought above 24 and bought more above 35. Now are able to avoid a loss. Remember, I said 80% chance they would be able to avoid a loss. So 80% chance we'd go at least one tick above the midpoint of their two buys, and you'll get some profit taking here from those bulls who are happy to get out without a loss. And then the bears are trying to maintain a gap below 24, but they probably will fail. They'll probably go above the 24 low. You have some bulls above the 24 low, bought more above 30 or 35, and they're trying to get out break even on that first buy and with a profit on their lower buy. And then the bears were hoping this is a wedge, 31, 37, 40, but it's a tight enough bull channel, probably buyers below 39. So I think not a strong sell. I'll get rid of this. We're probably going to be in a trading range for the next couple of hours, maybe until 11:30, possibly the rest of the day. The bears want a resumption of the bear trend, but the best they'll probably get over the next hour or two is a bear leg in the trading range, and it will be followed by a bull leg. So we'll probably not go a lot lower over the next hour or two. We might get up here, and it's possible we could get a big bull trend, but more likely this will be a minor reversal, and then we'll have to test down and get a higher low major trend reversal. You can see some selling around the 24 low, just like the 26 high could not get above the 18 low. Bears are trying to duplicate that. Unlikely. Normally, if you get a very small gap like that, and then a breakout and another gap, that gap closes. So we should get above the 24 low. Limit order bears probably selling 38 high, 37 high, scaling in higher, selling 24 low, knowing that the limit order bulls above the 24 low and lower will sell to take profits. So might get a little pullback here. Bulls getting gaps, 38 low, 33 high, 41 low, 37 high. But 60-minute moving average, probably a magnet. And this gap takes us right there. Now, what about selling below 41? It's a wedge, pull back to the moving average, but a doji bar, so not a strong sell signal bar. Tight bullish channel, so not a high probability sell. We're in a trading range. This is a bull leg, this is a bear leg in the range, this is a bull leg in the range. And traders will sell above bars, scale in higher, buy below bars, scale in lower, knowing that we'll probably not get a bear trend from here and not get a bull trend from here. So, buyers below, scaling in lower, sellers above, targets above, 60-minute moving average, and the 24 high. So sellers up here probably, and buyers somewhere down here. What do you do? Bulls, I think it's okay to get out of longs. For bears, I would wait for a micro double top to sell or sell with limit orders. Most traders should not be doing that. So best choice for the bulls to buy. Can they buy above 42? A high one and a bull trend. Targets above 24 high, moving average, measured move. It's still always in long, but if you buy, I think you need a wider stop because we may get a high 2 or a high 3. You see how it's hesitating at the 41 high? It's making it very easy for the limit order bears to sell. Whenever something is easy, it's usually bad. In other words, we're probably going higher. Can we get above the 60-minute moving average? I don't think we're going to go much higher without a pullback here. But it gave the limit order bears a lot of time to sell that 41 high. And when that happens, I think there's an increased chance that we're going to go higher. There's a general saying, good fill, bad trade. So anytime something is easy and looks good, there's probably something wrong with it. Might get a bear IOI. We started the bear trend bar 8 with a bear IOI. What's different here is this channel is very tight, and I think that lowers the probability for bears selling with a stop below 43. If you sell below 43, it's probably better to be using a wide stop and scale in higher. What do you do? Can you buy below 42? It's a surprise bar down and not a good sell signal bar. I would wait to see what we get. We may retrace half, maybe test the 38 minor, high or low. Traders are scalping at this point. There's enough confusion to make traders believe we're not going all that far up or down, and we're probably in a trading range. Is this bear trend resuming? Is it going to be a closed bear trend again? No. We're in a trading range now, and bears will take quick profits. They're unlikely to sell every low, every close. More likely they'll sell and then scalp out a bar or two lower. And bulls, if 44 becomes a big bull bar, not likely, they'll buy above 44. More likely, 43 surprise bar down, the bulls will wait for a couple legs sideways to down before buying. Most traders are scalping. The bulls who bought the 42 low probably will make money, but they'll probably need a wide stop, and they have to be able to scale in. Stop order bears, sell below 43. I would only do that if you can use a wide stop. Looks like more bears sold 41 high, and you got bulls giving up because of a possible wedge, 37.40, and that's what 43 is. Bulls giving up, but the bulls will probably buy lower. We have a bear trend, pretty good minor reversal up, breaking above the bear channel. and therefore bulls will look for a major reversal up from a higher low. If it goes below this low, they'll look for a lower low major trend reversal. Surprise bar, probably a couple legs sideways to down. So mostly limit order trading over the next few bars. Stop order bears would like to get a double top. Stop order bulls would like to get a small double bottom. What happens at 44 looks like 24. Well, you will get more bulls buying with a stop. But I think 43, enough of a surprise bar, enough of a big bear bar. Probably most bulls will want a micro double bottom. Bulls buying above 44 probably will use a wide stop and scale and lower, just in case we get 2 or 3 legs down, 1 pullback, 2 pullback, 3. Still always in long, totally reversing the 43 sell-off. Bulls trying to get up to the 60-minute moving average and the 24 high. I'm going to remove this measured move because now we've closed the gap. We still have a body gap. I always look at the breakout point. We pulled back and broke above it. Here's the breakout. Here's the breakout point. And look at the low, the bottom of the bodies here. They do not overlap the bodies here. So we still have a body gap, breakout point, and pullback. The bodies do not overlap. So that's bullish. So tough buy, right? Always in long, but big risk because the bar is big. Tight trading range, big buy signal bar. A lot of bulls don't want to buy with a stop above the bar, but a lot of them will buy with a limit order around a 50% pullback. So we're in the buy zone. So let's see if the bulls can get a bounce right where we are here. Bears micro double top, up 42, down 43, up 44, and they're trying to get a second sell signal below 46, the first sell signal below 43. But big enough reversal up 44, probably buyers below 45. Not a lot of bears will take that short. Looks like we're probably going at least a little higher because of this reversal, strongly down, strongly up. Tight trading range generates confusion. When there's confusion, traders assume the market cannot go very far up or down, and therefore they buy with limit orders below and sell with limit orders above. Use wide stops, scale in, and scalp. For the bears, a pullback and a bear trend, double top 26, micro double top 42, but pretty tight bull channel. And now a tight trading range with a pretty good bull bar 44. I think it's not worth shorting below 45. And for the bulls, it's a high 1, but tight trading range lowers the probability. The size of the bar increases the risk. Low probability sell, and always in long. So swing only, I would not take it. And for the bulls, it's a buy, but risk is big because the bars are big and the upside is probably not all that great. Reversing every bar, up 40, down 41, up 42, down 43, up 44, down 45, up 46. Trading range behavior. Limit order behavior. Bulls buying bear closes 43, 45 for scalps. Bear selling bull closes for scalps. That triggers the buy. Will bulls only scalp, or will they buy more higher, trying to get a gap? Tight trading ranges tend to resist breaking out. So the bulls need follow through, and the bears will try to get a bear bar on the next bar 47. Next bar, important. Bulls would like to get consecutive bull bars. That would increase the chance of a measured move up. They want a breakout and a measured move up. And the bears want the breakout to fail. they need a bear bar for the follow-through bar. The odds are against a successful breakout. This is more likely a bull leg in a trading range day. So more likely the 46 breakout is going to not get very far. You have the scale and bulls who bought the 24 high, one tick above it. They're trying to get out break even, and you can see we got exactly to the 24 high. Some of those bulls, instead of trying to get out break even, are so disappointed by this sell-off, they're putting limit orders to get out a tick or two below their entry price, and that's part of the reason we get that tail there. Possible final flag, so bull trend, tight trading range, and then breakout, and it's stalling. For the bears, it's a sell below 47 if they get a pretty good bear bar. The bulls are trying to avoid any bear bar. They're hoping to get a gap and a measured move up. This is probably a bull leg in their trading range, and therefore the odds are against this gap leading to a measured move up. More likely this is a magnet, and we're going to get pulled back into it, maybe down to the 44 low. The appearance of 47 is important. If it's a bear bar closing on its low, especially if it closes below the 44 high, bears will sell looking for a couple legs down. If it's a bull bar closing on its high, it's the high one. Bulls might buy for a little bit more up, but I think there's probably not much more up. Maybe we'll get to the 60-minute moving average, which would be about a 50% pullback. You can see they're fighting over every tick. Okay, it's a high one, but a bear body, so not a strong buy. It's a sell signal bar, but only one tick bear body, not a strong sell. So probably buyers not far below, sellers not far above. I would not buy. As for selling, I think the bears, if they sell 47 high, they stop somewhere up here, and they have to be scaling in. And stop order bears, I think I would wait for one more leg up and then a reversal. Not a lot of bears taking that sell. We get this all the time. You get a breakout and a reversal. The bears see it as a reversal. The bulls see it as a pullback. And that's what the market's deciding. Is 48 the start of a reversal, or is it simply a pullback from the 46 breakout? I suspect we're always in long. I suspect it's more of a pullback, and we have an important magnet up here. So I still think we're going to go higher. Limit order bears made money above 41, above 45, and they'll probably sell above 48 and 46, and they probably will make money as well. Always in long, target above. We might get all the way up to this high, but I doubt we'll get here. This is still probably a bull leg in a trading range, which means we'll probably get a bear leg at some point. Very often the market pulls back between 10:30 and 11:30, and then around 11:30 or 12, it tries to create a trend at the end of the day, either direction. And since we're rallying, I suspect we're going to go sideways to down, starting pretty soon. So probably more sellers than buyers not far above 48. Stop order bears are looking for a second sell signal. First one, 47. They know 46, surprisingly big, expect at least a small second leg up. 49 could be that second leg up, but the bears want another sell signal bar, and they want a good one, better than 47. Limit order bears sell 48 high and 1 point higher, or simply 1 point higher. It had to go 5 ticks above, which it did, and then they take their profits when it dips back below 48 high, which it did. So limit order bears are making money, selling above 41, above 45, above 48, and that increases the chances of a transition into a trading range soon. That's the second entry short for the bears, 47, but a bull bar, a tight bull channel. So I would not take that short. Would I buy the 50 low? We were likely to get a second leg up after 46, and this qualifies as a second leg up, and that makes me not eager to buy the 50 low either. So best choice right here is flat. or trade with limit orders, selling above, buying below, wide stop scalping. Tight bull channel, no clear top. However, no momentum since bar 41. A lot of sideways bars here and here. Tight trading range, only limit order trading going on here, or mostly only limit order trading, selling above, buying below. And a surprisingly strong breakout above this wedge. Probably not. 60-minute moving average, an important magnet. So I suspect we'll have to get closer to it. 60-minute chart, 2 legs down, 1 pullback 2. Remember I said the first reversal up would be minor. This is a second reversal up, so the bulls have a better chance of a test of the high. But we're starting to get a lot of small bodies, prominent tails, sideways trading. And I think this is not a very good 60-minute buy setup. Looks like minor reversals and more sideways. While not a very good buy setup, 3 bull bars, most bears are not going to sell above 51, even though they've been selling above bear bars 41, 47, 45, and 48. Bears trying to get a bear bar closing on its low for wedge top and a pullback to the moving average. 1 tick bear body, which is pretty much the minimum that the bears could do. I would get out of longs, but because it's only a 1 tick bear body, a lot of bears are not going to sell with a stop below 52 in a tight bull channel. I was willing to sell below 52, but I wanted more than a 1 tick bear body. If you sell, what do you do? Do you get out above 52, or do you use a wider stop and scale in higher? A tricky call. If you're selling, I think it's not a very good scalp, and you probably are better off using a wider stop. Right now, the bears have been selling with limit orders and not making money selling with stops. And for the bulls, it's still on the buy above 51, but not a lot of buyers willing to buy above the top of tight trading range trading. So confusion, unclear, usually results in trading range. Remember I said the market often reverses into 1130, so that's helpful for the bears. It increases the chances that it will pull back to the moving average 48 low, possibly 44 low. Fell 5 ticks and paused. That tells you that there are a lot of bears with limit orders trying to scalp 1 point. Limit orders to buy 5 ticks below 52. They just got their 1 point scalp. Probably will go lower, maybe 48 low. Whenever you have a wedge, 1, 2, 3, it's a nested wedge here, 1, 2, 3. The market often stops at the bottoms of the pullbacks on the wedge. Here's a bottom, here's a bottom. And then it decides whether to go to the next higher low or go sideways and form a bull flag. Stop order bulls did not make money above 51, and therefore they're probably not going to buy above 53, and that makes it likely that we're going to go down for at least a few bars. High 1, magnet above, but a doji bar, tight trading range, and stop order bulls did not make money above 51, so more limit order traders are trading. Bulls bought the 52 low and 1 point lower, made money. The bears sold the 52 low with a stop and made money, but traders are only making 1 point scalps. The range is very tight. So I would not buy above 53. I think we're probably going to go down more. It's a nested wedge. We have 1, 2, different ways to draw it. Let me redraw it this way now. Will the bears sell 53? Weak buy signal bar, weak buy setup. Limit order bears have been making money for over an hour. They probably will. I think we're going to have a hard time going up over the next few bars. I think we'll probably go sideways, maybe down 48 low, less likely 44 low. Limit order bears made money again. So it's becoming pretty easy for the bears to make money. A lot of times when the market has a strong trend early in the day, it tries to get a resumption of the trend later in the day. And the bears are hoping for that now. But this bull channel is very tight. And usually a tight bull channel does not become a bear trend without first going sideways. So it's unlikely that we're going to go straight down without going sideways first. And even then, I doubt. I think we've seen the high of the day and the low of the day, and that the day will be staying in this area for the remainder of the day. Might get up to the 60-minute moving average, might get down to the 44 low. High one, but mostly limit order trading. Both bulls and bears are making money with limit orders. The bulls are trying to get a surprise bar up, just like there was a wedge bottom and the bears got a surprise down and then another surprise down. Bulls are trying to get a surprise up, but most of the bars here are sideways, overlapping the prior bars. Tight trading range behavior. The odds are against a surprise bar. I say that, and it's breaking to the upside right now. If it's big enough, bulls will buy, but we're right at the target, 60-minute moving average. I am flat. I took several limit order trades over the past hour. I did not buy above 53 because of all the dojis in the weak rally, and I did not sell because the bears were unable to get a good sell signal bar 52, and 53 is a doji bar, and we have a magnet just above, and we have a tight bull channel. So 55, is this going to be a successful breakout, or is it going to be a bull trap? 56 becomes important. Right now, it's a surprise bar up, which is good for the bulls. Can we get all the way back to the open of the day and turn the day into a doji bar daily chart? Right now, I don't think so, but I'm open to anything. Bulls trying to get a breakout above a wedge top. Measured move is up there, or possibly just a measured move based upon this channel up here around the low of 1. The bigger this bar is, the more it closes on its high. The more it closes above the 60-minute moving average, the more likely we'll get at least 2 legs up. Part of this is the wedge bears 52 giving up when it went above 52. A bull trap is simply a bull breakout that fails. It traps bulls into hoping that they're getting the start of a trend. And you especially see them in bear trends. A bear trend and a bull breakout, it fails. It traps bulls. Bear trend, bull breakout, traps bulls into hoping it's the start of a bull trend. Very often the breakout's strong enough to make the market always in long, but it's still a trap. If you see a bear bar closing on its low, the bears will sell and the bulls will give up. Bear trend, strong rally. Always look to the left to see if there's a possible double top, and that increases the chances that it's a trap if you get that bear bar. Similar to today, a weak rally, bull breakout, and then a bear bar. You look to the left, oh, maybe it's a double top, and the bears will sell below that bear bar. Bear trend, bull trap. Similar to today, bear trend, weak rally, bull breakout, and then bears sell below a bear bar closing near its low here. Some bears will sell below that, not very good. It's usually better to wait for a bear bar closing near its low. Trading range, you don't expect a big bear trend, but you can at least get a trade down. And that's what we're deciding right here. Is this going to be a measuring gap, taking us back up near the open, or is it going to be a bull trap, a double top 21, and a reversal back down into this area? In general, whenever you have two reasonable possibilities, I always assume the probability is 50-50 until I get more information. 56 is more information. If it closes on its low, I think bulls should get out and swing bears will sell. If it closes on its high, the bears will give up and will probably get at least a small second leg up. Look at the past 3 hours. We had some pretty good selling here, but for the most part, every few bars it's been reversing. A lot of trading range trading that lowers the probability of this being the start of a big bull trend. It increases the probability that it's a bull trap. A trap is simply a breakout that fails. It traps hopeful bulls into thinking it's the start of a new, stronger leg up. And you can get bear traps as well. You can argue 32 is a bear trap, a bear breakout, and then reverse up on 35. For the bears to sell below 56, they want 56 to close on or near its low. Otherwise, they'll wait. Here, bear bar did not trigger the sell, and then a second bear bar that went below it, triggering the sell. But two dojis, a lot of bears wanted a bear bar closing near its low. Higher probability, but more risk. The stop is further away. It's really easy to look at these bars and say, oh my gosh, it's going to go all the way back up to the high. I got to buy. And you just got to train yourself to be patient and look at the entire chart and look at the context. It's not likely to be a measuring gap given how strongly we sold off and given how weak the rally over the past couple of hours has been. Bulls, I would get out below 56, and I would not buy above 56. Aggressive bears will sell on a stop below 56. Other bears will wait for a second or third bear bar, because when you're selling in a very tight bull channel, the probability is not as high as you want. Just like I said, I would not buy above 24 because you're buying in a tight bear channel. The probability is not as good as what the bulls want. So, confusion, but I would get out of longs below 56, and some bears will sell below 56, others will wait to see if we get 2 or 3 bear bars and then sell. And for the bulls, if 57 is a bull bar, let's say we get an II, a bull inside bar, consecutive inside bars, then bulls will buy above 57. But right now, this could simply be a buy vacuum test of the 60-minute moving average. The bears did not want to sell 54 high, knowing it'll get to the 60-minute moving average. So there's an absence of bears here, but there are a lot of bears here willing to sell at the 60-minute moving average. So the market could simply be being vacuumed up to resistance, and then the bears appear out of nowhere. Can you sell above 56? A bad looking high one. Given how weak the rally is, it's probably okay, but I would not do it. I'd rather wait for a stop entry sell. 56 is possible, or wait for 2 or 3 bear bars. And the bulls, they need a bull bar 57 or a more credible, higher probability high 1. As big as 55 is, it's not especially big compared to any of the past 15 bars. It's not much bigger than these bars, and it's certainly not bigger than these big bear bars. So bullish, yes, but not so bullish that people are thinking, oh my gosh, I got to buy at the market. I'm missing a great trade. The 2-tick tail on the bottom of 56 also slightly weakens the bear case. It would be better if it was only a 1-tick tail or a 56 closed on its low. That triggers the sell. Will the bulls buy it, or will the bulls give up? Will we immediately reverse up, indicating the bulls bought it, or will we go down 2, 3, 4 ticks, indicating the bulls are giving up? You look at these end of the day bull traps and you say, how can that possibly be happening? We've been trending up for 20 bars in a tight channel. How can it possibly do this after a bull breakout? It's simply a test of resistance. Bulls giving up and thinking, uh-oh, I bought a breakout and it's failing. I got to get out of here. So bulls are selling out of their longs. Bears are becoming more confident. It's unlikely that we're going to get a big bear trend out of it. But if it closes near its low, we'll probably get at least a couple legs sideways to down. If it has a big tail on the bottom, then probably more sideways. Becoming always in short. If it closes near its low, always in short. But probably not all the way down to the low. The market spent a lot of time going sideways here, so a lot of magnetism here, and therefore probably will stall somewhere in here. Can you buy above 59? Nope. In other words, is 58 a possible bear trap? And then we get a reversal up. Unlikely. More likely it's a surprise bar down, and we'll get a couple legs sideways to down. So close at the moving average, not on the low of the bar, but probably always in short. Probably will get at least a second leg sideways to down. I keep saying sideways because it might simply be sideways. But bulls will probably not buy above 59. Probably sellers above 59. Down for 4 or 5 bars. 5 strong bull bars still sold off. 4 bull bars sold off. Second entry sell. Here's the first, there's the second. The bear's got swing down. Trap. Sometimes you'll get what could be a bull trap, and it turns out that it's an actual start of a bull trend. Bear bar closing on its low, traded below it, but sideways to down for a couple legs. Remember I said when you get the reversal, you usually get a couple legs sideways to down, but sometimes that's all you get, and then a resumption of the bull trend. Bears, they can get out above any bull bar or 1 point above a bear bar. Right now their stop is above 58. They're betting that we'll get a second leg sideways to down. And for the bulls, 3 bear bars, surprise bar 58. I would wait for a second buy. So instead of buying the first reversal up, I'd wait to see if we get a second buy. We're back into this 8-bar tight trading range. The market thought it was a fair price, so it makes sense that the bulls would buy here. It was fair here, it's still fair, but they'll probably scalp, and there probably will be sellers not far above. So not a very good buy. What happens if 59 looks like 44, total reversal of the bear reversal? Then bulls will buy. But if it doesn't essentially totally reverse 58, most bulls will wait a repeat of 43.44. Would I buy above 59? I'm probably not going to do it. We're right at the 60-minute moving average. Would I sell above 58? Not with 59 being a big bull bar like that. So right now I'm trapped out. You can see most of the bears who sold scalped. Tight bull channel, unlikely to get a major reversal, more likely a minor reversal. But this is a surprise bar up like 44. I thought buying above 44 was a reasonable buy. I'm probably not going to buy above 59. 3 consecutive bear bars, 60-minute moving average. A lot of sideways trading here, here, and now here. So I'm trapped out. I'm not going to sell above 59, pretty good bull bar. And I'm not going to buy above 59 after 3 bear bars, a buy climax 55 at resistance, 60-minute moving average. I'm not buying this, but if it suddenly breaks strongly to the upside, I probably will buy higher and chase it up. Bears will try to get a double top, 56. 5 ticks up, trapping stop order bulls, and it had to go 5 ticks for the bears to sell 4 ticks above. It fell back below the 59 high, so the limit order bears who sold the 59 high and 1 point higher, or simply 1 point higher, were able to make a scalp selling above a pretty good bull bar. And the bulls so far have been unable to make a profit. Some bears are still short below 56, looking for a swing down. But I think it's tough to hold short when you get 59 and then 60 goes above 59. Right now I'm trapped out. We're in breakout mode. The bears have a credible sell, and the bulls, the sell above 59, I thought was not good enough. Might try to get, we have a microdouble top, but a bad sell signal R60. Bulls might try to get a microdouble bottom, 62 or 63. That would be a higher probability buy. Bears are hoping that we have a double top, neckline, measured move down to the 44 low. But why were they unable to get a better sell signal R60? And why did they allow 59 to look like that? So not good for the bears. Bears were likely to get a second leg sideways to down after the bull trap 55. 61 qualifies. However, 61 is not a good buy signal bar. Top of a tight trading range at the 60-minute moving average bear body. Everyone wants to trade, but the goal has to be to make money, not to make trades. The focus should be on making money. And if it's difficult to structure a strategy that will achieve the goal, it's usually better to wait. I don't know how many trades I've taken today. I've taken a lot of scalps. I have not had a losing trade today because I'm very selective. Anytime somebody tells you that they have a high winning percentage, they're telling you that they're scalping. Because if you have a very high probability of success, your risk reward has to be bad. And that means small reward relative to risk. Anyone who tells you that they love trades with great risk reward, huge reward, small risk, is telling you that they lose most of the time, because you cannot have a high probability of a trade with great risk reward. There has to be a reason for an institution to take the opposite side of your trade. So risk reward has to balance with probability. If one side of a trade has very good risk reward, the institution taking the other side has very high probability. A good risk reward trade is a low probability trade. A trade with huge profit potential, very low risk very little chance of making money. Buy a lottery ticket. What's your risk? $1. What's your reward? $100 million. So tremendous risk reward. What's your probability? Tiny. If the bulls get a bull bar of 64 or 63, that would be a triangle. High 1, high 2, high 3. And the bears unable to get another good sell signal bar. They had a decent one, 56, but not 60, not 62. So we're probably back to always and long after 59.60. However, the bulls need a good buy signal bar, 63. Bears do not get, they're not getting good sell signal bars, 60, 62. So instead they need a bear breakout like 22 or 26, 27, 28, which is what they're trying to do. They're trying to resume this type of behavior at the end of the day. Trying to get trend resumption down. Sometimes in a trend resumption day, here we get a big gap down, moving average, and you get a strong rally, and then later in the day, you get a big swing down. Same thing, sell climax, rally, and then trend resumption later in the day. Same thing, sell off, rally. Sometimes it's just a sell off trading range and then trend resumption or trend reversal. Sometimes it's a sell off, a rally, and then trend resumption. Bulls were hoping for higher low major trend reversal. Instead, bears got wedge, lower high trend resumption. Stop order traders in search of a good buy or sell signal bar. Right now it's limit order traders buying below things, selling above things, and scalping. Bears hoping for sell the close like we had earlier, here and here. Bulls are hoping this is a bull flag, a pullback from what they think is the bull trend. Probably always in short, but dangerous trading. We're in the middle of a bull channel. Remember I said we might test the 44 low. That's what the bears are trying to do, and the bulls are trying to get a failed breakout below a double bottom, and that is a wedge. The double bottom is 2 pushes down, and then if we break below and reverse up, we have a third push down. So it's the same forces that are present in a wedge. 3 attempts down, reversing up. Now instead of 2 legs sideways, we have 2 legs down, 58, 64. However, the bulls want a strong buy signal bar of 64. Otherwise, they will not buy. Bears are concerned that we're not going to do this or that, and I don't think we will. We're back into an area where the market went sideways for an hour. Up, yes, but mostly sideways bars here, here. So I think we're probably going to stall back somewhere. I think we'll probably stay in this area for the rest of the day. The market thought it was fair for the past couple of hours, and therefore they probably still think it's fair. If the bulls get a bull bar of 64, bulls will think about buying, and in part it depends on how big the body is. If it's a 1-tick bull body, a lot of the bulls will wait. If it's a 4 or 5-tick bull body, more bulls will be willing to take it as a high 2 buy, 2 legs down, 1 pullback 2. Most bears were not expecting a big bear trend, and therefore they're looking for reasons to take profits. The minimum that the bulls could do, a 1-tick bull body. Bears, they'll get out if they have not already scalped out. This is unlike this where we had relentless selling. This is a bear leg in a trading range. This is a bull leg in a trading range, and this is the trading range. We don't know if the 64 low will be the low for the remainder of the day, but it's unlikely that we're going to go all that far up or down. The bears are hoping that we just keep channeling down to the low of the day. But stop order bulls made money 64. That reduces the chances of this going a lot lower. I think fairly difficult trading if you're a stop order trader. Limit order trader, pretty easy. You sell above anything, you buy below anything, and you scalp. Bulls made money buying below 58, below 60, 62. Bears made money selling above everything, 54, 59, 61. Will they make money selling above 64? I don't know. They probably will, but I would not take that sell. To me, that's a good place to get out of shorts. We've been down for about 10 bars, and we've had a lot of trading range trading for 3 hours. And then bull scalpers, bull swing traders. I don't think anybody's really swing trading right now. Look at the past several hours. This is not a swing trading market. The bears are hoping 65 is a low one in a bear trend, and it is, but probably buyers not far below 65 or 64 or 44. We're probably going to have mostly limit order trading for the remainder of the day and not a repeat of this. We're getting prominent tails, a lot of sideways trading, smaller bodies. Now, why did it stop exactly right there? Because there were limit order bears who sold 64 high and higher. They needed to go one tick below 64 high, and therefore a lot of bears have limit buy orders at the 64 high, and the bulls know that, and the bulls are trying to trap them. But with all this trading range trading, the odds are limit order traders up and down will make money. So right now, I still think we'll drop below that 64 high, and that those bears will make their money. Are we always in long or short? You can argue either way. I don't think it matters. Nobody is trading always in. Traders are scalping. You can see we're reversing every 2 or 3 bars. The limit order bears who sold the 64 high and 1 point higher made their money. They sell 1 point higher, 2 points higher, and then they buy back the shorts. It has to go 1 tick below 64 high. Limit order bulls, we're getting a little bit late in the day, so you'll get some limit order traders unwilling to trade with limit orders, because if they like to scale in, you can easily run out of time at the end of the day. But probably buyers below 65, below 64, below 44. Bulls trying to break above the 60-minute moving average and get back to the open of the day, reversing all of that sell-off. More likely, we're going to be sideways for the rest of the day. However, there's a real possibility that we could get a big bull trend bar closing above 55, and then the start of a move back up to the open. Odds are against it, but you got to be ready for it. For the bears, a double top, lower high, major trend reversal. So bull trend, bear breakout, double top, lower high. But 4 consecutive bull bars and a lot of limit order trading. I think it's difficult for most traders to do much in here. For the past 20 bars, a very tight range. This is not the kind of environment where most traders should trade. The math is too difficult for stop order traders. Limit order traders are selling in the top third, buying in the bottom third, and scalping. And they're also buying below bars and selling above bars. You can see we went above 62, and there were sellers up there. Math not good for a scalp below 68. Okay, swing, but low probability, right? You're taking a chance that we have a double top, lower high, break below the neckline, measurement down, but more likely we'll stay within this range for the rest of the day. Big tail, not a very good sell setup despite double top, lower high, major trend reversal. Limit order market for the past 20 bars or so. Bulls trying to get up to the open of the day. They're trying to reverse that early sell-off. Chances are they will not be able to do it. That sell-off was strong, and this rally so far has not been nearly as strong. Bulls trying to get the breakout back above the 60-minute moving average. They're trying to convert the limit order trading into trend trading. They're trying to get a buy the close rally into the end of the day. It's a little bit early for a buy the close rally to start. Bar 64 is at 11:50, and if the day is a strong bull trend day, a buy the close rally can start at 11 o'clock. It can last for a couple hours. If the day is not a strong bull trend day, today's not a strong bull trend day, and you get a buy the close rally starting before 12:30 or so, it usually will not make it to the end of the day. So this is probably not going to go straight up. We'll probably get a reversal down at some point. If it's a strong bull trend day, a buy the close rally can start at any point and make it to the end of the day. Here we're trying to get trend resumption up. And you can see we got a pullback here. This is the problem possibly today, that it might be starting too early because the day is not strong enough. So bull trend, mostly trading range trading, and the bulls tried to get a buy the close rally starting at 11:30 and could not last, could not make it to the end of the day. Same thing here, a lot of good bull bars, but trading range day, buy the close started too early, 12:05, did not make it to the end. Trading range day, trying to start at 11:55, good looking rally, but could not make it. Bulls trying. They're trying to do the opposite of this. They're trying to get a buy the close rally. Buy closes by above the highs of bars closing near their highs. They're trying to convert a weak rally into a strong rally. Bulls, none of these buy signal bars was very good. 64, 66, 69. And they're trying to change it. They're trying to get bull bars closing near their highs, like that. And that's a higher probability buy above 70. And then if 71 is also a bull bar, that would be a logical start of a buy the close finish. Bears are hoping it's another bull trap like 55. Important bar, 71, because it's the follow through after a breakout. The bulls at a minimum want no bear body. If there's a bear body, a lot of the bulls will get out below, even if it's only a small bear body. If it's a bear bar closing at its low, bears will sell for a failed breakout above 54. If it's a small bull body, that would be good for the bulls. If it's a big bull bar closing at its high, that would be very good for the bulls. Buy close bulls in a buy the close bull trend like to buy bull bars closing near their highs. If a bull bar closes more in its middle, the bulls are less willing to take the buy. So there was a buy above 70. I did buy it. But on 71, if it closes in the middle, I will not buy it. A lot of times during these breakouts, I'll buy them as they're forming. But end of the day like this, I waited for 70 to close, and then I bought on a stop above the 70 high. Now, a possible parabolic wedge, 65, and then pause, 67, and then pause, and 70. Higher high, major trend reversal, but I would not take that sell. And yes, it's a bull body, so it's follow through after the breakout, but not closing on its high. So I'm not going to buy above the 71 high. It's still always in long. Bulls will get out a point or two below any bar, including a bull bar, and they'll get out one tick below a bear bar, especially if there's a bear bar closing near its low. And for the bears, we have an 8-bar bull micro channel. Even though we don't have consecutive big bull bars closing on their highs, the bulls have owned the market for 8 consecutive bars. Therefore, low probability sell below 71. I would not sell. High 1, possible measure move up, 70 gap. But I have to say, I wish it was looking stronger than it is. Gets us near the open of the day. I still don't think we'll get all the way there. I'm not buying above 72. So right now I'm trapped out. It's a reasonable buy, but I don't like that tail 71. Too much risk of a micro double top 74. On the daily chart, the bulls are hoping that the 2-day sell-off is just a micro double bottom and a high 1 bull flag. But I think that this is climactic. 4-week bull micro channel with 3 legs up, not micro channel, very tight bull channel with 3 legs up. And the stop now is here or here, too far below. The bulls have to begin to reduce positions. And if you're a bull and you sold out of your longs yesterday or today, because your stop is down here or down here, you're not going to be buying back your longs tomorrow or the next day. You'll probably wait a week or two, 5 or 10 bars. And therefore, I think the upside from here is not great. And there probably will be sellers not far above. I've been talking about the top of this parabolic sell climax since it started. And it's a magnet. I suspect we'll get there. But I also think that either we've seen the high, which I think we have not. I think we'll go a little bit higher. I think either we've seen the high for the next couple of weeks, maybe next month or two, or we'll go up to around this high, maybe a little bit higher, and that will be the high for the next month or two, and then we'll drift back in something like this, or maybe not as flat, maybe more sideways, but basically like this or like this. So I think the next couple of weeks will look like that, sideways or sideways to down like that or like this. However, as I said, right now it's still, I think, slightly more likely we'll go a little bit higher after these 2 bull bars. So today is a buy signal bar for tomorrow, but not a very good looking buy signal bar, especially after yesterday's bear day. And 5-minute chart, well, I'm talking about the 60-minute chart. The bulls had 5 consecutive bear bars here, pretty tight bear channel, and therefore today's gap up was likely not to be the start of a bull trend. I said there'd be sellers above, and there were. We went below yesterday's low, and then we reversed up, and basically sideways for about 10 bars or so. Breakout mode. The bulls want trend resumption up. The bears want trend reversal down. The bears do not yet have a good looking top, and therefore more sideways to up is more likely, and then down. On the 5-minute chart, we had a very big gap up. Yesterday we had a reversal, late reversal. We were in a bear channel, reversed up violently, up and down, up and down. We had a gap up, and I said on the open that it was a possible wedge rally, 1, 2, and then 3. However, bar 2 is only a doji bar, and bar 1, big gap up, is a decent bull bar, probably always in long. I said that it's unlikely we were going to get a strong trend up or down, and that the odds were 80%. We'd either get a wedge rally, which we got, or a double top, a wedge bull flag, or a double bottom. The bulls wanted a double bottom, but they were unable. So we had a wedge top and then a sell off and then a reversal up. The bulls tried to get a wedge bottom here at 19. You can call it a wedge, different ways to draw it. Sell climax, pause, sell climax, then pause, and then sell climax. You can call it a parabolic wedge, or you can call it 1, 2, and then 3. We had a micro triple bottom there. However, it was a 12-bar bear micro channel, and therefore, even though 19 closed on its high, the first reversal up in a bear micro channel, usually there are sellers above, and they sold. We had a low one below 21, but a bull bar plus a bull bar 19. At that point, I thought we were going to go a little bit lower, but not a lot lower. And then 22 was a surprise. 23 followed through. The bulls tried to get a reversal. 24, good looking bull bar, but probably not enough to reverse the surprise 22, 23. So it's a low probability bet buying above 24. It's a possible low of the day, but even if we were to rally, the first leg up would probably be minor. It failed. Some bears sold below 26, others below 27. And then we got another surprise down, 27, 28, 29. And therefore, we probably will get at least a small second leg down, which we did. We got 2 more legs down, 32, 34. And then a reversal up from below yesterday's low. Three bull bars, 36, 37, 38. Probably a minor reversal. It might be the low of the day. It's the second reversal up from below yesterday's low. That's always good. The first one above 30, not very good. The second one above 34, not good. But waiting for a bull bar 35, that turned out to be a better buy signal bar, or higher probability buy signal bar. And we channeled up 44. Really not a major trend reversal, only 2 bars down. This is the major trend reversal, 64. However, it did not reverse up all that strongly. Once we were down here after 12 bars down, probably not going to the new high of the day. And then once we broke below the 18-bar low, less than probably a 10% chance of a new high of the day. However, we tried to reverse. I thought we were going to get up to around the 60-minute moving average. We got a little bit above, and I thought the day would be mostly sideways for the rest of the day. It was sideways to up, sideways here, down here, up here, sideways here. So a weak rally, reversal second half of the day, but not very strong. For stop entry traders, you could buy above 1, and my concern was what I said. Yesterday's high is resistance. 1 is not especially big compared to the bars to the left, and it's far above the average price. And a lot of bulls don't want to pay far above average unless they're buying price action that is far above average. And this reversal down and this one as well were warnings that this might not be far above average bullishness. Bar 2, the absence of a rare body, so we're always in long, probably buyers below 2, buyers below 1. Bar 3, not a good buy signal bar. We had a surprise bar of 4, and therefore we're going to get a wedge top and not just a low 2. Low 1 below bar 2, low 2 below bar 6, but likely to get one more push up and then a possible wedge top. 8, we have an IOI, we have an inside bar 8 after an outside bar 7, a bear bar closing below its midpoint near its low, and 3 pushes up, 1 pull back, 2 pull back, 3. This is a credible high of the day. I talked about how we could get a wedge rally on the open for a swing down, which we got. 10, a give up bar, a big bar, surprise bar, bulls giving up. So at a minimum, we'll go to the moving average. The bulls will try to get a double bottom, a lower low double bottom, but 10, we're always in short. 13, the bulls tried to get a lower low double bottom, bar 1, test of the moving average, but a weak buy signal bar and it never triggered. 14, an inside bar in a 7-bar bear micro channel, so a low and sell, but support below 60-minute moving average yesterday's close. However, Another surprise 15, probably going lower. Then we get a micro triple bottom 17, 18, 19. Bulls trying to get a reversal at bar 18, but we have 6 consecutive bear bars, or not 6. We have a 12-bar bear micro channel, despite 19 being a good-looking buy reversal bar and arguably a wedge bottom, a wedge bull flag, a 50% pullback, a test of yesterday's close. A very tight bear channel. I thought not a very good buy. And then we got another wedge attempt, 24, after a surprise bar, 22, 23. 22, 23, strong enough for at least a small second leg down. That lowered the probability of 24. 24, a reasonable candidate for the low of the day. Wedge bottom, good-looking bull bar closing on its high. Possible sell climax, test of yesterday's close. But same problem with 19, very tight bear channel here, 12-bar bear micro channel. 2 big bear bars here. Sometimes I'll buy 24 as it's turning up, and I think I did. And sometimes I'll even buy above 24 for a scalp. But why did 22, 23 look like that? Consecutive big bear bars closing on their lows. Usually I don't want to be buying with a stop above 24. I would wait to see if we get 2 or 3 more decent bull bars, like 35, 36, 37. The bears got another low 1, 26, higher probability selling below 27, closing near its low, and then a surprise bar 28. So we're probably going to get a couple legs down. First leg ended with 30, and then we have a low 1, 31, but a bull bar, consecutive bull bars. Yesterday's low support. I would not short below 30, 31, probably buyers not far below. The bears got another low 1, 33. You can call it a small double top, 31. But probably buyers below 33. And then we got a small wedge, 30, 32, 33. Another bottom attempt after this bottom attempt. So it's consecutive bottoms, consecutive complex bottoms. Complex meaning at least 2 legs down. Here we have a wedge, high 1, high 2, high 3. And then a bear breakout, high 1, high 2, micro wedge. A reasonable candidate for the low of the day. Second failed breakout, yesterday's low. So for a swing up, buy above 35. First reversal up, probably minor, although it lasted a couple of hours. It lasted the rest of the day. Buy on 36 or 37, probably always in long. Buyers below 37, high 1, 38, but a bear bar. We may pull back and test the 34 high, but always in long. 41, 42, not all that big, but we're channeling up. Pretty tight bull channel. Probably sellers above. Limit order bears. We'll probably sell above 41. You can call it a micro wedge, 3 pushes up, 35, 41, 42, but tight bull channel and buyers probably below 42. 43, a surprise, but not a good stop entry sell because this bull channel is too tight. So I would not take the sell. 44, reversed 43. We've done that, did that 3 times today, similar to 59, and then again here at the end of the day, 78. It's always in long, about 44. But now we got a 5-bar tight trading range, and the rally is getting weak, stalling. Might get to the 60-minute moving average, but probably not much higher. For the bears, a failed breakout 46, 47, but a bear doji bar, not a good sell. For the bulls, a high 148, a pullback from the 46 breakout, but 2 bear bars, probably limit order trading. Buyers below 47, sellers above 48, and this was all limit order trading. The bears had an attempt at a small wedge 52, but only a 1-tick bear body and a very tight bull channel, so not a very good sell. Bulls got a breakout 55, but it could simply be a bull trap. I want to see the next bar. If it closes near its low, 56, it's a reasonable sell looking for a couple legs down, which is what happened. Bulls tried to get a high 159, but we're probably going to get a couple legs down after the buy climax 55. So not a very good buy. We have a high 261, but a bear bar right below the 60-minute moving average. And then the bears got a micro double top, 60, 62, but big tail and a tight trading range, probably not going down all that far. 64, 2 legs down, 58, 64, and a bull body, possible higher low major trend reversal. A higher low double bottom, 44. The bears are hoping this is like this. Reversal attempts up, keep failing, and we keep going lower. With all of this two-sided trading, I think the odds are we're not going a lot lower. It's a swing by about 64 or 66 or 69. None of it all that strong. Bar 72, a failed breakout above 56, failed breakout above the 60-minute moving average, but a 9-bar bull microchannel. So probably buyers below 72. High 174, but big tail sideways, end of the day, not worth taking. So stop entry trades, realistically, the first one that I thought made sense was below 8, and then below 10, 11, maybe 12, 14, 15, maybe 16, closing below its midpoint, below 22, 23, above 24. I'm not opposed to taking it. I just said that I would not take it because the probability was not high enough. Then the bears sell below 27, 28, maybe 29, and reversal up here. Bulls would buy above 35, maybe 36, pretty big tail, 39, 40, 44. Bears might sell below 52, and they would sell below 56 or 57. Bulls, I would not buy above 58. Not a great looking sell below 62. 63, better, but not, I think we'll stall in this trading range. And then for the bulls, buy above 64 or 66 or 67 or 69. None of it is all that high probability. Buy the close, sell the close. Surprise bar 10, sell the close, 10, 11, 12, 13, 14, 15, 16, 17. And then surprise bar 22, so sell the close, 22, 23. Surprise bar 27, so you sell the close either 27 or 28, 29. And then the reversal, 32 down, 35 up, follow through 36, 37. It's probably buy the close, but not strongly bullish. Limit orders, the first ones traders would consider would be buying below 2 and selling above 6. Selling above 6, taking a chance on a wedge, and then selling above 18. That was probably the highest probability limit order trade of the day. Buying below 31 or 33, but beginners cannot do that. However, they have a decent limit order trade below 37, looking for a second leg up. And then through here, it's all limit order trading. Traders sold above prior highs, they sold above bull bars, they sold above bear bars, and they bought below bull and bear bars. In general, you're looking to sell above bear bars, 41, 45, 48, 54, and buy below bull bars like 42, 50. In general, that's what I try to do. And then also sell above prior highs, 46, 52, and buy below prior lows like 58, 54, 48, looking for reversal scalps. Looks like a weak rally after a strong sell-off. So it looks like we're probably going to test down at least to here tomorrow, maybe all the way down here. I think we're going to have very quiet trading, not very quiet, but quiet trading for a couple of weeks. And we're going to pull back. We might go a little bit higher first, but I think we're going to pull back, somewhere here in February. But I think we're going to pull back. You see my cursor moving around. What I'm doing is I'm moving parts of the the GoToWebinar control panel. Good question. What is the probability of selling above 38 for a test back down and above 64 for another leg down? Above 38. We just went always in long, and we have consecutive bottoms. We tried to bottom here, and then we have another bottom attempt here. For me, if the market just becomes always in long, I'm usually only looking to buy. So you're at resistance. It's probably a minor reversal up. The math is probably okay, but I would not do that. And then 64, what about selling above that? That was a special situation. I was looking for 2 legs down, 58, 64 qualifies. and we're in a bull channel. I would not sell above 64, although it was profitable. The traders that sold above 64 sold more, a point or two higher. It came back below the 64 high. But to me, we had 2 legs down, so in a lot of trading range trading, I'm starting to look to buy. So at that point, I'm looking to buy. Trading range, I want to buy low, not sell low. It's reasonable to take a chance that we're going to continue down like this, but I thought the odds were that the reversal up was strong enough. It lasted 20 bars. The odds were, and we had a lot of sideways trading here. I thought the odds were that the market would have a hard time falling far below this. So I switched to looking to buy. A question, it seems like we get mostly limit order trading in the last few hours of the day, so I feel very comfortable selling a strangle around 10 o'clock in the closest expiration cycle. What type of things should I and limit order traders watch out for with this sideways noon approach? And we talked about this the other day. He's saying today's Wednesday. You got options expiring. I don't know, they certainly will be options expiring on Friday. A lot of times there are options expiring on 2 or 3 days during the week. I didn't check today. But anyway, let's say he saw a lot of trading range trading in here, and he decided today is probably not going to be a strong trend day for the rest of the day, so he's selling a strangle. He could do it with the E-mini, the S&P futures, or with the Spider. But let's say we're somewhere in here. He might sell a put here and sell a call here, betting that we'll finish the day somewhere in that band, and he'll get to keep the premium from the short call and from the short put. If the option expires today, if the option expires on Friday, let's say, he may simply buy back the put and call with a profit. It's a reasonable strategy. I've talked about this many times over the years. Not often, but I've been talking for many years, so I have talked about it many times. I started trading back in 1987, and Merrill Lynch, I gave them, I forgot, $100,000 or something to manage, and they gave it to a guy who they said was a fabulous trader, making a lot of money for his customers by selling naked puts. And the week before the crash, 1987, he had a whole bunch of naked puts in my account. And on the Friday before the crash, I told him, get out, I want you to buy back every one of my puts, and I don't want to have, I think the market might crash over, on Monday. I don't want any short puts, because if you're short, let's say he's short, I forgot how much it was. Let's say he's short $20,000 worth of put premiums. If it crashed, you could lose $500,000 in a day. And I was fortunate, even though I was a beginner, I sensed that something was drastically wrong with the strategy. Selling puts, selling calls, selling strangles, which is selling puts and calls, is a high probability strategy. Okay, and that immediately tells you that the risk reward is terrible. High probability you're going to make money, but the risk is very great. So rarely you're going to lose, and the loss could be so great you could wipe out the past 100 wins. And that's what the crash in '87 did to probably all of his clients except me. I don't know how many of his clients. He argued with me like crazy on that Friday morning before the crash, telling me, "No, Al, you don't understand. It's the best time in the world to sell more puts because of the fear factor into the premium and building up the premium." He did not want to close out my positions, but I told him, "Listen, I want you to close out every position, every one. I want you to close them all out." And he did it, and I never heard from him again. And my guess is he probably I don't know if a lot of people did bad things. They committed suicide, they quit their jobs, they got fired, they went bankrupt. He probably had something like that, something horrible happen to him, because he probably lost millions of dollars for his clients on that day of the crash, Monday morning. And so I don't see how he could stay in business. Merrill Lynch would fire him. I don't know if Merrill Lynch had to cover any of those losing accounts, just because it was such a stupid thing for him to do. But going back to your question, selling strangles, which is selling an out-of-the-money call and an out-of-the-money put, is a high probability strategy. You're probably going to make money regularly. Most days, it's a very high probability strategy. And it's a very good strategy if you are an institution and you can hedge those puts and calls. So you sell a call here, but you might buy an upside call or an out-of-the-money, a later expiring call to hedge it. You sell a put here, but you may be buying a lower put or a later dated put, and you may be running a delta neutral strategy. You may be buying spiders or selling spiders, or buying E-minis, selling E-minis. So if you're an institution, you'll do a lot of other things to reduce your risk. But if you're an individual trader, it's fun to win, and selling puts and calls is a very high probability strategy. But when you lose, the losses can be devastating, horrible. And therefore, except in rare circumstances, in other words, a very experienced trader who can manage his trades, especially if he can hedge when he puts the positions on, I think traders should not be selling options, naked options. Hedging, yes. Naked options, no. So selling calls in Apple, if you own Apple, that's fine because it's hedged. But selling strangles, I personally would not do it. And I see so many things going on the chart. I took a lot of trades today, and every trade was profitable. So for me, I'd rather just focus on what's going on the chart and trading what I see rather than taking a chance of some crazy thing happening. Crazy things happen much more often than you'd think. For example, yesterday a trader could have said, "Oh, it's a bear channel, I'm going to sell calls," and then all of a sudden the market rallies 15 points, and the short calls end up costing him a lot of money. But if you're watching it really closely and you're able to react quickly, make decisions quickly, then you can do it. But I personally, I don't trust my ability to do it perfectly. And you just need one terrible mistake, and it can wipe out a whole bunch of good earlier trades. So the logic is good. The implementation is, I think, difficult. It's difficult to do it successfully long term. Black swans are much more common than what you think. Question: for someone looking for a trading platform well suited to your style of trading, what are the good alternatives to TradeStation? To be honest, I haven't looked for years, so I'm really not the person to ask. I'm an old guy, and I've been doing. If you call TradeStation up and they say, "What's your customer number?" I tell them my customer number, and they say, "Well, where's the other digit?" I tell them, "Ain't no other digit. I'm one of your first customers." So I've been with TradeStation forever. This build 10, I think, is horrible, and I'm willing to change to another company, but I don't have the energy to look into it. So I'm really not the person to ask. I think you can ask in some forums. Futures.io, they might have information, but I'm really not the person to ask. I just don't know. Question: why do you think most people fail as a trader? Is it that most people lack persistence? There are countless reasons for people failing as a trader and for anything. And in the videos, I've I forgot the numbers of the videos, but toward the end of the course, I have videos in which I talk about losing because of mistakes. And I talk about a lot of the common reasons why people fail. And I think one of the most important, there are 100 reasons why, 1,000 reasons why, but one of the most important reasons why is patients they don't pick the right trades, or they use stops that are too tight, or they take a trade thinking they're going to do something and then they don't do it. They don't follow through with their plans. So pretty much anything you can imagine is a way to lose money. And back in the 80s, I probably lost money every conceivable way, and early 90s as well. And now, back then I couldn't imagine how I could ever feel relaxed as a trader. I could never imagine how I could not lose money. And then now it's hard for me to imagine, you'll hear traders say this, it's hard for me to imagine the things that I was doing that was causing me to lose money. The things that to me right now are unthinkable. So the things that I thought were normal and a good way to trade, now I look at them, I can't even envision them anymore. And there's just so much against what makes sense to me that I would never do it. But I think traders should trade small. Whatever small is, I would trade half that size or a quarter that size. And just try to hit singles. Don't worry about hitting home runs. Just try to consistently make money and be selective. It's more important to take fewer trades and manage them well than to take lots of trades and hoping the law of averages works out for you. Take a lot of high probability trades. Even if you don't manage them well, the probability is still good enough. Maybe you can make money. I would not do it. So I know I'm not answering your question, but a good source of information is that video about mistakes that traders make. Okay, question. I missed your explanation on equilibrium yesterday, but once again, the daily equilibrium was 2640.50 today, with the day session just below. Is that a strong magnet? I don't think so. Okay. I forgot there's a word for it. I forgot what it is. I don't even pay attention to it anymore. But I would not pay. I don't. Look at my charts. You never hear me talking about pivot points or daily equilibrium. I don't care. There's a special word for it, and I have to put up volume to see. But there's a word for pretty much the average price of the day, which changes as the market goes down. The average price goes down with it. As the market goes back up, the average price goes back up. And theoretically, that is a magnet. The market tends to oscillate around the average. The average changes all day depending on what the range is. But I don't pay any attention to it. I think, if you want, you could write programs and try to trade it. But it's kind of like trading with a dome. I just don't. I like to see exactly what the market is doing and trade based upon what I see the market doing, and not trade with things that are not really visual. I want to trade the price action. If the market's going down, I want to sell. If it's going up, I want to buy. And I want to see how strongly up or down it's going. If it's trending weakly, I look for reversals. And I can win a very high percentage of the time trading that way. So I don't want to be using anything that's not clearly intuitive. I like seeing the day unfold and just do whatever the market is doing, go in the direction that it's going. So I'm not interested in things like the daily price average. Excuse me, I lose my voice at the end of every day. It's really hard for me to talk. So I did not answer your question well yesterday, and I also did not answer it well again today. But what I'm saying is I have no interest in that kind of a thing, because
I cannot see it on the screen. I can see approximately where the average is all day long, but I'm not going to be trading based on that. Here's my average, the 20-bar exponential moving average, or the 60-minute moving average, and that's enough for me. And then I draw lines in, and I just look for support and resistance and momentum, and just trade that. Also, for me, that's fun. It's fun to try to get a sense of where the market is going. Excuse me, I'm sorry about my voice, but every day I just run out of a voice. Okay, so probably more for the next couple of weeks, increasing amount of two-sided trading. And over the next month or so, I think we'll pull back somewhere down here, somewhere in the middle of this rally, whether or not we go a little higher first. Okay, hope everybody has a good night.